good morning to you all. And Angeline, anniversary.
It's amazing. So excited. Can you see? It's real, everyone. It's real. And, we had Terrence in it.
Nice. Right now, speaking of the show must go on, then it's time to swap. We say CFDs let you speculate on the price of financial instruments like shares, indices, forex, and commodities without actually owning them. You can benefit from both rising bigger positions with less money up front. So this increases your profits on your trades, but also remember your losses are also justified. Manage your risk. You're not alone. You're part of a wide community of traders that you can learn from. New lights.
It's like Manhattan loft meets trading room meets birthday party or anniversary party. What a combo!
So the first day that we had was Tuesday because it was bank holiday, wasn't it?
Oh, of course, yeah.
And we spotted that I had the light right on my bald spot. So they managed to fix that. We couldn't do it with yours, sorry.
Yeah, not quite enough light to do that. I was looking at some of the spare construction stuff. I could make some spare construction.
Special. Yes. We've had 3 sets of numbers yesterday. We could call them the good and the ugly. We'll be going through those stories. Of course, was the absolute incredible move in America. This is one that's gone right up top of Trump, discussing it as great. Just tick on TikTok. Curries. Having gone into each other's stores, filmed secretly, and it is really funny. But results yesterday from Currys prove that it's also working.
Yeah, I mean, look, from here on my screen, we had a 16% up move yesterday. A decent revenue beat, £50 million share buyback. The Nordic region as well, interestingly, was quite strong, we see. But yeah, I mean, for someone like a Currys, and that actually segues quite to the fact that is the UK retail market suffering like we perhaps think it is when you're looking at all the headlines. UK retail sales this morning, another beat at 7 a.m.
Right.
on the monthly. So again, for anyone who's hoping for more rate cuts, that tells you perhaps there's a little more life out there. And again, it's not dissimilar to the have you got any fake for the last little while in any case, and that's probably just
what Labour are about to do. If they pull it out of the bag, then there's going to be an almighty rally in the FTSE 250, isn't it? If they actually come thing that isn't cutting spending increase.
I mean, things are, if you look at the 100 versus the FTSE 250, it's a gain. And if we're looking at things like retail, where they are ticking up, and we're looking at things like the Curry's numbers, in not as position as the when sentiment is outstretched, as we know, or as we've been presented budget in, what is it, November, and pretty bleak. But if markets
performance, actually, considering what individual shares like EasyJet that we see there.
Yeah, listen, look, I mean, I say all the time about where, especially with sterling still cheap on a 30-year basis, if you're an overseas acquirer, there are still times, if you argued this for the IG, say, and if we're not careful, they're going to end up owned by somebody else rather than UK shareholders.
Right. Papers. Then we've got the FT there, and stablecoin group Tether holds talks investing gold miners. Did one coming? That is that's so yes, the crypto company of 5.7 billion. They clearly don't know what to do with it, so they're going the reverse way. They're going in traditional gold rather than
if you can
gold.
have the US taking a stake in Intel, then you can have Tether taking a stake in a gold miner, right? I mean,
got reality check for of Doge there, and mention lump sum withdrawals over tax concerns. So people getting.
Well, I think as well, very clear that some of the talking about for handing your wealth over when you go, you're almost off sharing it out now, or maybe because rates are looking very stubbornly stuck around probably the 4% mark, maybe you pay mortgage or other debt as well. Unfortunately, with things that, I mean, another 4 years of the government in its current form, with the greatest respect to them, it's a difficult playing field, but they've managed to score. I'm overdoing the soccer analogies, but they've managed to score quite a few own goals today, so you're not expecting any windfalls from the government. So if you got cash now,
there's been no fantasy football this week, so don't panic. That's
well, I do think you should have copyright on some of your journalists.
Or Goldman's.
Yeah, exactly. After watching Trade Live with IG, I've heard it is the most watched channel at Goldman.
That's right. We're all over the trading floor there.
All over the trading floor, yeah.
That's right. So Goldman's saying that 5,000 could be. I mean, it's certainly been a huge week for it, hasn't it?
It's been. The amount of people I've seen who have called a top in gold over the summer, absolutely nothing. So there's a reset in expectations, there's a reset in positioning, and then it just says, I mean, if you look, it was when it just did nothing, and all of a sudden it just explodes higher, and then it cascades.
2022, because of course we were seeing the melting of the unprofitable tech, especially getting carted. However, gold also went down on concerns to monetary policy tightening, but you're right, it did nothing. Tech.
No, that's true, and as you rightly said on the podcast, when you're looking at these physical commodities, in real terms, even though it's 3.5 Olympic sizes, swimming pools have only ever been mined.
Yeah.
The considerations around the actual holding of this, you get no yield from it. It's simply a proxy hedge. When markets are just going down at that rate of, all of a sudden says we're going to tighten, babies do get thrown out.
I heard a great term yesterday from. They heard that before,
No.
but it makes. If you've seen a 34% decrease in the Nasdaq, then of course your thing that's all shiny and unchanged, then you sell that to buy into the thing that's fallen so much. So yeah, that's one of the reasons why. As well.
Sophie tried real hard to try and make it. Guess the chart. Guess the chart. What? Indices, exo commodities, every step on all your needs. On our anniversary, can you guess the chart? Will we guess the chart? Will we guess the chart? Can you guess the chart? Can you guess the chart?
Let's do this. Hello, Pat Cash. So good. fittest, mentally the toughest, but turns. That's something else. Watch and learn. Cash returns coming. Hey guys, where are you going? You're not going to get better than cash returns.
Oh, the bell, where's the bell?
And it was, of course, Scotty's favourite stock, where he gets his lycra from. Angeline's going to cover that in fast markets because she's the Lulu expert. But yeah, that's great numbers, especially when you out with great numbers.
Brands which positions itself in a sweet spot for a while, a little like the Peloton phenomenon that we've all not all paid. I paid, lots of other people paid for a.
Did you get one?
Expensive. Well, yeah, long. It was half price because of some really rich person that we know had one for their holiday home in Cornwall, but it didn't fit the account, so they literally sold it to us for half price. And so
Get that bell in your hands, Scotty.
It's hiding.
Where's our new one?
Oh, what?
We got a new bell. I'm going to go for it.
No, I can see it.
Beautiful.
That's amazing. Oh,
wow. Oh, that sounds brilliant.
That is so refined.
Our bull as well. Since we've had that, the market's only gone one way.
There you go.
Right, Scotty, we got off and running. The futures were up, and we're seeing come through there as well. What are first movers?
I mean, Fresnillo again. It
We also have today up 1.5. China was strong overnight. China up 1%. The Nikkei was strong overnight, of course. America doing although they have recovered, to be fair.
Yeah, and they've made a
better.
Yeah, and they kind of like the deal this week as well with the US in the Nikkei. Says a bit later on about bonds because that's going to be a good thing to look at. Entain again having another move.
Scottish mortgage investors catching up with the Nasdaq move. Was something to watch for, isn't it?
Yeah, that's it. These kind of names in the UK do get forgotten. These kind of ultra safe, ultra solid, high div. Yeah. Because there's so many other things catching your eye. You do forget sometimes that those real staples are exactly that. Whitbread
is starting to draw my attention in because every time I've looked at it before, whenever it's been 28 quid, Next thing, it's been 33.
Yeah.
So I
Is there a chance you
am.
could bring the chart up on that, Rich?
Yeah.
Let's have a little look at them. Let's just see.
They really 28 quid to 32 pounds is the range.
Yeah.
So if they started with a 29, I would be very tempted to have a little look there. So that's the daily. Let's bring you much closer in.
Yeah.
There we go. So 28 forever for about 3 months, and then they jump up to 32, and they struggle around there. So it's this the budget.
Yeah, I do think these kind of names, just these little things, like the Curry's numbers, like the retail sales data, you know, the UK is stubbornly all right, in spite of all the, you know, spike in job losses because go away, and they're 30 quid stocks for a reason. Yeah. They're not £3 stocks, they're 30 quid stocks for a reason. And
Not
anything that goes up 80% of the day gets my vote.
NatWest down. Astro 40, Reckitt's. So yeah, just a little bit. So
defensive drift, yeah. I mean, again, that's what markets are doing again.
Tell us why they all move as one like that, Scotty.
Well, because generally you just get a bit of early rotation. Generally have nowadays, as we were talking earlier on off air, about CTA machines and how people buy relativation, as we call it, on a great deal.
But straight down to 590, and now it's managed to burst through that 6.
DAX in the next reshuffle. They
really have been.
Drop out, yeah.
Adidas recovering there as now who was saying Gavin Akers pointing out to us the 3 stripes are starting to recover. They are. Havas has been 154 forever as well. NatWest cut form in P. That's why NatWest is down 1. Thank you. That.
Yeah, that makes sense.
Andrew McKelvey's been talking about Peel Hunt since before they opened. Boy, oh boy, have they performed.
Yep.
Up 10%. Good timing, because on the next week, we've actually got Charles Hall, is head economist or head strategist across at Peel Hunt. Head of research across at Peel Hunt. He's coming on to the podcast to talk about the UK next week. But
that'd be interesting.
They've done well, haven't they?
If he does say some interesting things, Deutsche bought Numis a couple, and everyone was saying, "Oh, that's a waste of money. That's a shocker." Very quietly, they've actually been doing okay. And this is what I mean about it's stubbornly okay.
That tells a bit more of a story, doesn't it?
No, that's right. But again, it's the expectation where you can't have all these negative arrows out of the UK and have a Peel Hunt or a says was
If this is now down 40%, we're really stupid, aren't we?
Yeah, well,
Up to 2% after an 80% rally.
surely that's just bid off a spread, isn't it? That's just, yeah.
Now, just a reminder, if you were one of the ones, the lucky ones, better to be clever than lucky. If you are one of the ones that went into this stock, Graham first them, which was at 40 odd pence, was it? But in the mid 40s. Or, like me last week, you had a little nibble. 100%. And when you're up 100%, there is a temptation to let half the position go.
It's the classic
Your original investment. And then you can't lose. can you?
free.
So yeah, so just
Very smart.
yeah. Then we should probably mention why. Now, of course, the news that came out, the defense holdings have partnered, I guess you would say, with either Google or Amazon, because it said it was one of the Mag 7. So Google or Amazon, and they're presenting their first AI software at the defense conference. And government. So some people might say the UK's own Palantir, but
Well,
certainly traded like it yesterday.
I mean, it's when we actually start making noise that we do have these companies.
To see all of you in the chat this morning, and if you are watching the show, subscribe to YouTube, then subscribe. Also, just under where you're watching our ugly mugs there's a little thumb like this. If you hit that would be very much and it's joined the Discord this morning, and also asking what's the FPL league code. I think we might need producer Phil to we'll see if we can get you that this morning.
My goodness me, that's frightening.
So, right, I shall bid you farewell. We'll see you soon, and see you after the break.
Watch Trade Live with IG from 7:30 a.m. on our brand new YouTube channel at Trade Live with IG.
As well as the live show on our new YouTube, you will find our full beginner's course to trading options, daily YouTube shorts of all the action that happens after the show's finished, and Trade of the Week and Psychology of Market.
And don't forget to hit those like and subscribe buttons for more exclusive trading content.
Let's do this. Hello, Pat Cat. Fastest, fittest, mentally the toughest, but the cash returns. That's something else. Watch and learn. Come on, Pat. Cash returns. Come on. Hey guys, where are you going? You're not going to get better than cash return.
Do you like the sound of tax-free trading? Well, that's exactly what spread betting enables you to do. This tax-free way of trading lets you speculate on the price of over 17,000 financial indices, forex, and commodities without actually owning them. With spread betting, you can benefit from both rising and falling prices, letting you find the perfect opportunity. So if you think up, you buy. If you think it's going down, then you can sell short. Not only is spread betting exempt from capital gains tax, but it's also commission free. All you pay is the spread. With us, you're not alone. You're part of a wide community of you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Hello, I'm Axel Rudolph, Senior Technical Analyst at IG and Fellow of the Society analyst with over 30 years experience in trading the financial markets. I've been following cryptocurrencies from the very beginning, and with IG's new crypto offering, I can finally share my technical analysis expertise on crypto with you. So join me every Wednesday morning for my new show, Chart, where I'll be answering your technical analysis questions on all things crypto, live on Trade Live with IG.
Hey, welcome to
Yeah, that's right. Yeah, I
my
like that.
goodness.
Yeah,
Yeah.
definitely.
Meet yesterday with Avago, Broadcom.
Yeah, up 4% last night. Quite choppy in the market, which is a bit of a feature of the tech names, but that would definitely help sentiment with all the tech names yesterday again as well, pretty much bar AMD. But for those other peers like the TS Origin, so that's definitely one to watch. But as we've already flagged on the chart of the day, Lulu.
I know. Painful.
That's right, yeah.
So almost like price to perfection, whether or not we get a shock, you know.
And we keep going, look at the Japanese yields and it calms down. But yeah, maybe no one knows what's going on. Forex.
I'm starting to also redirect, you know, my dollar averaging towards banks and towards more defensives.
Yep.
And expected correction. I mean, I did a piece on how to trade September.
Oh, yes.
There is an interesting question as well. So the key three about. So, you know, look at diversifying into defensive. You think there is going to be right? If we still have that trend in place,
Yeah.
tends to be where the roughness is.
Yeah, that second half definitely seems. And also as well, it's no coincidence it's expiry as well.
Yeah.
Second half of the month, once expiry is out of the way.
And the last lots of events that you can trade because it's still very macro rich. Right? We've got
Massively.
obviously today we've got non-farms, we've got you know, our eyes are on what central banks do. So watch out for those news events that could move markets. Gavin Ackers coming online saying 15-year-old loves Adidas, and he is a
Interesting.
non-Nike lover. Sorry, Rich. I'm quite a Vans. Off as a Vans type person.
Yeah, never really. The fact that I'm a calamity on a skateboard, it's never.
I'm not into skateboarding.
No,
Into
but
the
I think as a. Three months, wouldn't it, in particular? But I think the US has just erased that. Shifting is happening. I think because so many people are still underweight Europe for choice, that you probably won't see the DAX react as impulsively as maybe the US does, where there's still a lot of overweights. But yeah, it's a definite.
convergence of 50 moving higher, and we start seeing the twisted rope that she said me off. I really like that term. And when you start seeing this, it's time to kind of take a close look.
Is real for how.
Yeah, I mean, you're high, not too hot, not too
I don't disagree. I certainly wouldn't want to be in New York of the Bureau of Labour Statistics. One of the definitely numbers is Trump's rates, and again, it was weak. The ISM jobs number the day before was also weak. So there's a definite slowing in the hiring, but the economy just keeps trucking along. But yeah, I would be surprised if it's a big blowout in either directions. But again, it's the revisions. The revisions have wiped a lot of job numbers off the totals in the last 3 to 6 months. So yeah, the market seems pretty primed for not being able to case where if it's a strong number, it means the economy's fine. If it's a weak number, more cuts, and that to me just kind of smells a little dangerous again.
Yeah, right. Speaking of danger, we have Pamela Lebrams, Joachim Clement waiting in the wings in a time when we've got all these interesting events coming up, and also signals from the bond markets flagging danger, danger. Just a quick roundup. We've got tech stocks rising among the top sector performers in Europe today. Also, we have covered Lululemon. Oh,
It's all right. It's all right.
Ørsted also losing 1.3%. This is the Danish wind farm developer after it cut its operating profit outlook. Right. I hope you're staying for some cake later on.
Well, I think you can see I never avoid a bit. It's auspicious. Oh, I did think actually when I came in this morning, I thought it was the magic of television, and there was some kind of CGI cake. But then I realised, thanks to Terence, if he's made that himself, man of many talents.
Yeah, if you guys can make it into, please, OGs, come here and have a slice. Right, stay there because Joachim is coming up next to talk about airlines, because we know Rich is about to go on his holiday. And we're going to talk Lufthansa, Ryanair, EasyJet. Stay right there.
Do you like the sound of tax-free trading? Well, that's exactly what spread betting enables you to do. This tax-free way of trading lets you speculate on the price of over 17,000 financial like shares, indices, forex, and commodities without actually owning them. With spread betting, you can benefit from both rising and falling prices, letting you find the perfect opportunity. Going up, you buy. If you think it's going down, then you can sell short. Not only is spread betting exempt from capital gains tax, but it's also commission free. All you pay is the spread. With us, you're not alone. You're part of a wide community of traders that you can learn from. We've got the experts, the tools, and extensive educational resources to help you on your journey. If you're not quite ready to trade with real money, you can always give it a go on a demo account. Open an account today, join the conversation, and be inspired to make moves.
Let's do this. Hello, Pat Cash. So I've always been known to be the fastest, the fittest, mentally the toughest, but cash returns. That's something else. Watch and learn. Come on, Pat. Cash returns, come on. Hey guys, where are you going? You're not going to get better than cash returns.
of him. But he said, you know, even if you are in a bubble and you think that this is an market rally, it doesn't take you to go out. And at this point, and I think that is really wise advice. You all know, and as the saying goes, markets can stay irrational, good, and you can stay solvent. So into yes, I was 15% for the S&P 500. This is why you should and it has all been dominated by the news about the Fed cutting interest rates. It's a world where it's fighting for the independence of the government. In this camp, the economists and the Fed itself expect at this point in time. Increases the risk premium that inflation might rear its ugly head at some point. This is why the yield curve has been going up in the US, and eventually that will take its toll on. Where I would say that this is going to happen imminently. It can for quite some time, unfortunately.
Up the chart for you so you can see the yield there as 4.16 right now for the 10, 4.85. Do you think there for the September or Spooktober trend is no longer? I think we might still get some roughness in the last of the month.
Well, we've got non-farm payrolls today. We've got the criminal investigation that has been launched against Lisa Cook and the Fed. So there's a lot of stuff that can no longer in the camp. So it is more a situation we just kind of have to deal with the volatility. Where I think things will calm down, at least for now.
At least for the non-farm payrolls, you know, it's all about, you know, you disagree?
Well, I mean, if the payrolls numbers comes in very low today again, what is Trump going to do? Fire the next guy? It's really tricky on that front. But I think what we have to keep in mind is that U.S. population growth slowed down quite a bit. Fewer jobs created because of that. There was a study that I came across 2 weeks ago which said that in the past 1-2 years, 100,000 new jobs every month to keep the unemployment stable. Now that has dropped to about 85,000. So even a number like 80 or 90,000 is not bad news anymore, even though the market will still interpret it as bad news. In fact, it's kind of the new cruising height.
Let me show you, since you're talking about population growth. There is an amazing graphic that shows the fertility rates. And this is done, friends, really well-respected and long-time colleague of mine who is like a genius in the... He used to be LSEG Reuters, and he's now gone to Flourish, which is... I'm going to show you this because it's on have long term, because these demographics do matter, like a 10-year, 20-year view in your investment horizon. Lots of people chiming in on the chat as well. Let's get the chat up on the board so that we can have a look at them. Usman Ali saying, hi, do we see downward pressure for the pound after the November budget? Sorry for being late on the naughty step, Usman Ali. We've got a late step. We've got a late step. You can join Kate Murphy. Is Kate here? Kate's sometimes late. We love Kate. She's got Rolls Royce on her. But Usman, if you look at my screen, you can see that on the main page, if you whack that up, you can go to a place called Shorts, and on the Shorts page you'll see me talking about topical reactive stories every day, and one of them is this one: markets smell trouble for the UK pound outside the Bank of England yesterday. Downward pressure. You know, we all know that
summer months. Business taxes or small fry. And sooner or later, we're going to go down that road of getting especially in the Anglo-Saxon world. I'm in the UK, or I live here now, so frantically afraid of higher taxes because satisfaction rate that lower taxes be further from the truth. Actually, there is a unanimous literature on that correlation between taxes and GDP growth is zero. In all developed world. Why is that? Because while taxes take some money out of the pockets of they put money into people's pockets. Know that for every pound way more than £1 back in terms of GDP. So at the end, it's a net positive.
if you're wondering about, in terms of the mood music surrounding what the Bank of England will do, the latest it is likely because more specifically by Claire Lombardelli and also Megan Green and this which suggests actually none of them will vote for a rate cut in Q4. So we have that in play as well. Also, away from the numbers coming on as well, under pressure again recently. Goat.
Yeah, and it makes no sense. I mean, it's like unless the German citizens and German investors care about the UK, it makes no sense.
And Rich is about to go on holiday.
Good on him.
So, yes, well-deserved rest. I mean, we are 1 year old today, Trade Live with IG, and so pleased that we have got to this stage. New sets, new cameras, new light. Our fantastic community here. It's close to, is it 1.6 terans, Dom? Do hit the like and subscribe button. We're going to talk about airlines next. Joachim, do you subscribe?
Yes.
Just checking.
No.
Just checking. Joachim has got a lot to answer for here. Not only has he got me into a lot of different in my investment vocabulary has increased, by the way.
Excuse me,
and
what
also,
did I do?
also my driving vocabulary has increased. So it's this man that basically it was a joke to guess which new car I went for. But they
Oh,
were
the best
with me on the
possible
journey.
car.
But it's this
The
man,
same car that I drive.
and he many moons ago, we met way before then, due to Zurich and Davos and what have you. But many moons ago, he bravely said yes to allowing me to drive his brand new Polestar, still a Polestar, and it was quite a far drive as well.
It was to your home. It felt scary, yes.
Did it usually come, or was that just a German demeanor? Oh my goodness. So Ryanair, let's talk about airlines. Let's talk about airlines now.
Yeah.
Do you think Ryanair is looking interesting right now?
Really interesting place for some 3-month trades. And the reason is that
3 months, people, is a duration.
basically into year end. And here is Ryanair and Deutsche Lufthansa both sold off quite a bit. They are now very close to oversold levels, but at the same time still well above the support from 200-day moving averages, and in one case I think Ryanair even the 100-day. In any case, it is ripe for a bounce. And the reason why I'm optimistic is more from the fundamental side, because both last couple of weeks have seen earnings upgrades from analysts in reaction to their, well, mixed. Oil prices are low and remain low. It's the key driver for a lot of airline stocks because it reduces fuel costs. Prices in order to stay competitive. And we do see that in the UK ticket prices for flight well, what that I think in Europe, because we've seen such a strong euro this year, and because
nicely with that. I think is the level, and yes, oil prices are expected at. You know, I love it when people call my theory, but
Sure.
I also want to poke holes in other people's theories. You know, by what we saw in terms of outlook from Jet2 recently, because that caused all of the travel sector to slump.
Yeah. So Jet2 is suffering from cost holiday space. Matter where the packaged holiday business is a smaller share, if at all, of the company.
Speaking of which, you also like Lufthansa.
Yep.
Let's have a look at Lufthansa there.
It's not a company that I like fundamentally and on a long-term perspective, but as a trade, it's actually quite interesting.
Right, so I've got the ATR up there at the moment. Volumes remain relatively low.
Yep.
But is this the same sort of premise compared to Ryanair?
It's the same premise. The last results on the 1st of August for the second quarter showed that costs eased materially because of lower oil prices. But they have seen and they have decided to cut capacity in cargo and in the European routes, which are the most profitable ones, which is why people sold off the stocks. They basically have priced in lower margin 6, but as analysts have started bullish, we see more upgrades in recent weeks, and I think all the negative news from the second quarter results are now priced in, and it's time for a rebound.
What's interesting as well is that Lufthansa and I believe it's Lufthansa and TUI have already started and they've started offering more routes.
Yeah, the big new vacation. Yeah. It's the only place where you can still go in Europe in summer.
Norway.
I mean, in the newspaper that I subscribe to, there's a pretty good travel section, and every day there's a new travel article, and about half of them are either about Norway or Sweden or Denmark or something like that. And clearly, I mean, I spent a week on a conference in August. It was hot even there. I mean,
Any more questions for Joachim? Because he's a very busy man, he has to go, but I will put it in front of him. And subscribe button, and also if you email and ask@ig.com, I will get your question. Joachim, stay with us.
do this. Hello, Pat Cash. So guys, I've always been known to be
Welcome back to all the off to the races. I'm going to also invite Bill Blaine in because Bill, love that you are with us on our first off to the races. Up 6% there after that. Up 3%, and we've got some of the quantum computing names up 2.6. Just coming back a bit. Any of those names, can you see them, Bill? That you?
To be honest, the one, and that's really when it's fed so curious. Badly, it all goes wrong at some point.
Oh, wow. So you've been talking about this moment for a very long time.
Different things going on in the world. I mean, obviously, the most important thing we've got is going to be today's employment data. So now I get you, right? People like me come on board, and we have to. It's happen about 3 o'clock this afternoon. No, actually true. We've got a whole series of factors influencing markets, and my guess is at the moment issues are more likely to lead than they are to. And I think that's what we should be discussing today. Not the imminent end of the world.
Yep, not yet. So get us through the. I'll get us through the big moves. Broadcom, of course, moving higher after the company forecast Q4 sales that were above estimates. Moving over to brings me pain. People, Lululemon down 17% after the company cuts its full year profit, and also sales forecast. I'm glad now that I gave up waiting for the bounce late messages from me, but yes, red today. Nike as well, sorry, Nike is down 1.3% there for chiming in and telling us what your son or down by a third, not by much. So some of the consumer names like Walmart as well and Walt Disney. We've had a huge number of people joining a debate this week about we are about to finally see the bond markets.
Oh, Angela, markets always pay attention to the bond market. There is also an enormous amount of gibberish talked about the bond markets, and that's very apparent at the moment. I would advise anyone to go into their LinkedIn profile and just the multiple issues sourced from GDP or from Grok, saying that 30-year rates in the UK and in the US spell the end of everything. No, what that increase in rates is telling us is that there is a clear inflationary threat. And this is what we talked about last week with my buy the long the short end, as we say, and the long end. Expectations going to result in a steeper yield curve, relatively low, but long-term interest rates will continue to climb higher. That is not what we're seeing in the world. Where it gets interesting, and mentioned MicroStrategy is an interesting game, is when you get a clear inflationary impulse, which the market is now anticipating. What does it do? It goes for safe havens. What's the ultimate safe haven? Gold. Where's the gold price this morning? Well above 3,500. Everyone is flying into gold because it is the traditional inflation hedge. What are they doing with Bitcoin? Well, Bitcoin's had a bit of a sell-off, this rising inflationary trend. To me, that just illustrates that Bitcoin is that a fund that basically just holds Bitcoin, that its net asset value is actually more than the value of the Bitcoins it holds. Doesn't make sense to me, doesn't make sense to clearly speaking to the wrong people because it continues to go up, as you've seen it this morning. Now, I think as people start to realize that Bitcoin, of course, is not an inflationary hedge, that's when it becomes, again, interesting. That said, I am never going to predict an absolute tumble in Bitcoin because inevitably I will be wrong. Enough people out there who will think, and they won't be able to answer it, but they'll say, it looks cheap, so I better buy it.
Well, Bill, hold that thought because we're just going to go to a Sting Expert Edge Sting and we'll be right back with you. But do hold that thought because we're going to dive deeper into that and also this continuation. Right, welcome back to Expert Edge. Capital advisors with us in a time when we've got continued inflation fears still rife. We've got bond markets giving us these red flags over and over again, but markets don't seem to be taking notice. Are you in the camp of markets not likely to correct until it's too late and we get a huge shock? Or do you think things are out of whack this year and actually markets can ride higher for longer? Be solvent?
Great questions. Let's try and put them together. Markets are out of whack in some. You have to remember, of course, I'm talking about this, Angeline, that markets are omnipotent. Markets are just votes if everyone participates. And if everyone buys a particular narrative, then the market will tend to that narrative. And that's a problem for people like me who employ common sense to look at the markets because we're wrong. Because instead of the markets following common sense, they tend to go with the narrative. So people who are trying to be clever and awfully smart, like myself, well, I'm not clever or smart, but like commentators like myself, we get caught logging wrong, and that's why we're always wrong and predict 17 impressions when in fact you don't get any. Hang on a second. The magic of the phone, managing to switch it off with my watch. The real issue, though, for markets, I think, remains just how bubblicious some sectors are and how they're not really factoring in how the world is changing. Now, this has been a fascinating week, especially starting off with this Shanghai conference, which was actually held in Tianjin on the China coast, which is a fantastic place, by the way. They've got breweries. India very much joining in the Chinese axis. Now, that doesn't mean that China and India have issues to resolve. They certainly do. But it's clear that Donald Trump has managed to drive a wedge between USA and India China. That actually backs up one of my big investment theses, that the world is going to head a global economy that is centered on South. And that makes them we have this clear inflationary impetus, and now we have these major concerns. Now, what really interests me is what's happened in the US this week. And now, Lorraine being accused of being a fraudster, and we've seen Rachel Reeves under attack. It's going to contain yet. There's this concerted attack on the government, and one of the things that's been used to size it is this narrative: 30-year bond rising to 5.7%. I would just
yeah, and
you know what?
we've
As
talked.
I was saying that, for some reason, my mind went back to the Clint Eastwood film in history.
Oh, go on then.
Which
one?
was Paint Your Wagon, Clint Eastwood in a musical. Can you remember it?
No.
Now, don't ask me why that came old, but there you go.
I think of Goldfinger.
Friday mornings.
Yeah, I know. Yeah, but you're right. I mean, gold, look at it. Everyone said, this was interesting. Trump's as well, and all his and moves towards the Fed. But I think this is you're right. There is this effort out there by governments to almost, it's like almost like fearmonger everyone into thinking actually it's going to be.
It's basically right. I call it the Tory graph, but I don't just mean the UK paper, The Telegraph. It's a whole right-wing commentariat who want to show how terrible Labour are. So they've magnified the story. And the fact is that UK 30-year interest rates are higher than they were when Liz Truss was in power. But Liz Truss was in power when interest rates were much lower and there was not the same inflationary signal. Completely different thing. And then if you take a look at real interest rates, that's the rate of interest less inflation. Series I've been trying to get the out for years. It says that if a country has a stable currency, a sustainable bond market, and political currency, things will tend to go well. Of course, the other side of that is what are the things that do badly? Well, when you start to see the bond market destabilize, there's nothing wrong with the UK bond market just now. In fact, we just had some very successful auctions of 10-year gilts. We're also seeing this year cover, that's the number of people who buy and put in bids to buy government bonds, almost never fallen below 3 times covered. That means that we could issue 3 times as many gilts as. Now, since Labour came to power, the Debt Management Office of the UK Treasury has issued over 300 billion of gilts, and that supply has been absorbed without any problem by the market. The only signs of stress that we've seen are a slight diminution in demand for the 30-year bonds and longer. And that's simply because of inflation and the fact that people expect long bonds to go down in price, up in yield, because of inflation and the steepening yield curve. So there's really nothing to worry about with the UK gilts market. But yet, as I say, if you read the front page of the press, the right-wing press, and you read all the stories, which all seem to be taken from the same page in Grok, about what that means for the collapse of the UK, it's nonsense. The fact is, short-term interest rates will fall. Now, the importance of that is critical for the economy, because if you're going to start investing in the economy, you're going to have to go out and borrow money, and you want to be able to borrow money at a steady rate, and you want to know that the economy is going to do well. You want to have a clear understanding of what the policies are, that it's everything stable, that it's a safe investment environment. Now, the fact that 30-year is an issue, but the fact that the shorter end, where you're probably going to go out and borrow money, are still low, that doesn't stop investment. Really interesting, I think, in the States just now is this whole of the stability of policy. You know, Trump flip-flops the whole time. I was just reading and I was watching some of the dinner last night in Washington, where you had the massive long table and all the words, and it was almost like they all took turns to praise Donald Trump.
It was the kissing of the. It's the ring. The kissing of the ring.
I'm going to be a tad rude here. Which ring were they kissing? Oh dear, Billy, you can't say that.
Oh dear, oh dear. At 9:18.
But the thing is, they all went round and they all said, "I'm going to invest this much. I'm going to invest this much." But the thing is, I don't think any of them have real plans for investment out with what they were already going to do. What they want to do is sound like they are being very supportive of Trump. I think many of them are worried about where Trump goes next. Things like buying stakes in Intel and other companies like rare earths producers that are considered critical for the economy. Does Trump decide that the best way to sort the US's problems out is simply to nationalize Facebook or take over Google? yes, it's extreme, but 6 months ago, none of us would have believed some of the stuff that we accept with question today.
Which is also why I think, we're seeing those moves in crypto, and because let's face it, as long as Trump 2.0 is ongoing, we all know he's very pro crypto. That space is going to be well supported.
$5 billion in profits from his crypto ventures since he became president. Crypto, isn't it? I'm not mentioning anything about crony capitalism or anything like that. But when Eric Trump speaks at every single crypto conference and doesn't have a clue what any of it is, you know that there's something funny going on.
Yeah.
I mean, the one thing I'll say about crypto is I have bought an Ethereum a long time ago, dropped it into my Coinbase account, forgot all about it, and I suddenly discovered I'm a fractional millionaire in Ethereum.
Oh my
I'm
goodness.
told that demonstrates my cleverness. The fact that I don't have a clue what the reason it's gone up. I know it's something to do with the fact that Ethereum used for settling trades and all that kind of thing. But
Also,
I bought it because I just was curious.
Recently, if you saw that recent leg up in Ethereum, it's come off now, but it's also because a lot of the legislation that just came through was very passed with no problem whatsoever. And there's now talk on the media that Ethereum could have another leg higher. So if you've stayed in it, perhaps you might want to look at CoinDesk and, a lot of chatter. But one thing that not based on chatter, but based on fact, is that there is intensifying demand for GDP options, right? Ahead of that November 26 budget. And these options expiring beyond that date. I mean, this just means continued near-term weakness for sterling, maybe beyond as well. But I agree, the whole mood music
The Fed, that remains one outside the States a massive issue. I mean, because we just really can't contemplate the Federal Reserve will no longer be independent. And I don't think it's worth even talking about whether it happens. It effectively has already. We are beginning to see Fed members sidling up to the Trump administration. And remember, it will be gone in May. It's going to happen. But really, at the end of the day, what difference does it make? Because if you take a look, even if the Fed cuts, said that will be inflationary. That doesn't mean that the bond. I mean, I've had this argument. It really surprises me when people say, well, if the Fed cuts interest rates, bond yields will go down. No, if the Fed cuts interest rates and the bond market agrees that makes sense, bond yields will go down. If the bond market says this is going to create inflation because you've cut too early in a hot economy, and that will drive, that means that the future value of our redemptions will fall because of inflation. So we're going to sell bonds rather than buy them. So it is the bond market that sets bond yields. And if Trump thinks mistakenly that if he cuts interest at zero, he's making a mistake, because the rate is by a massive repeat of quantitative easing, where to buy back long-end bonds. That's going to be really interesting, because when they did that during the QE period, it didn't create inflation, as we all feared, in financial assets. From 2000 to 2023, the value, the stock market quadrupled. That's financial asset inflation. And that's what will happen again when Trump takes over the Fed. So there's a prediction saying a massive crash has come, that the US is forced to buy back bonds, to bring down rates to the levels that. Now that is going to be enormously distorting. I think it will finish the dollar. So you might see US dollar assets go up, but if you're a player and the increase so, that's not going to be attractive.
Now, this is all very interesting stuff, because this, listening to, and this theory, all this means to me is that, you know, the tech sector, you know, stocks, they'll remain, they'll just continue to ride high.
Yeah, but they won't be actually more money.
Yeah, it's just inflated.
And that's why it's going to be fascinating to see what happens. And remember, the US tech sector is, let's be honest about it, 90% of the global tech market just now. That will come under pressure. Places that can do things. Now, one of the other, I started off this morning by saying you've got to take a look at where global wealth is going to be, the people who are going to be buying all these goods and services. And they're no longer in the West, they are in Southeast Asia. And these are the guys who are going to be to buy the best. Here's an interesting thing. A few weeks ago, you showed me a picture of a car we're thinking of buying. Now because Range Rover just died. And I took a look at all the usual suspects. I decided I'm not going to buy a Land Rover because this one should not have died, and it did, and it's destroyed the equity I had in the car. So I'm thinking about other things. And while I was looking in one of the showrooms, they had all these Chinese cars. Now, I can't even remember the names of them.
Were you BYD? Were you BYD?
No, it began with a no, this one, a Moda or something.
Oh, Xpeng Neo?
But it looked like a Range Rover. And it looked pretty attractive.
Yeah.
And so I sat in it, and the guy said, well, before you start it, you have to plug your seat. It won't start unless the seat is open. And it wasn't a SsangYong. It began with O. Chinese car began ridiculous. We don't even know the names of the products we're talking about.
And know what?
Anyway,
You can't remember the name of the mark of the car. That's really worrying.
You know what? I was mightily impressed with it. It was plasticky, I will admit.
Yeah.
But it was mightily impressive. I think about, because it's less than half the price of any of the other competing cars in the area. I thought, maybe I should just... And then asked about the warranty. Now,
Yes.
one of the reasons I've walked away from Land Rover is they're offering a 2-year warranty on their EV plugins. 7-year warranty. Now that's, when you drive a car as badly as I do, that's an important to bear in mind. Anyway, I decided I'm not going to buy a Chinese car. I'm going to do something else.
The key issue, I mean, I'm talking about the listed ones, right? So your, your Neos. Neo is fascinating. Those of you that are in the space, but to me, Neo is still very much a very volatile stock, and if anything, this is a short, because they have gone with the strategy of cost as well. Their USP is they're going to have these pods around Europe, and you can drive your car into the pod, go for a coffee, and come back, and without any human intervention, it will change your battery for you at a low cost. So that is what they're aiming for. We have someone who is very knowledgeable on cars as well, that's come online.
It's the Moda 9 that I was talking about.
A Moda 9. Yeah. So the main problem at the moment, I think, is structural, because I think they've come leaps and bounds in terms of the tech, and that's why I was looking at the tech was incredible. But you can't easily drive it anywhere if there's an issue. Lots of people chiming in as well. Julian asking who would buy bonds at basically 0% interest and then buy them back at 5%. The Bank of England says tax money. Yeah, we're just talking about that as well. One of the key things about tech as well is we have, of course, Oracle coming up with earnings quite soon. Just having a look at that, because we had someone on the chat earlier asking about Oracle. Have you got any thoughts on Oracle, Bill? Just having a look at the daily chart here.
Oracle is a good... goes through its period where it is hot and it changes the world, and then we begin to understand that it is becoming increasingly commoditized, and what it does is something that is required for the economy and for the business, and it reaches a value. I can't think of any reason to think that Oracle is suddenly going to become a hot stock again, unless it's simply this AI. That is suspicion about an awful lot of the tech sector. It's basically a coattailing the narrative, and it's a very similar narrative to what we saw with the dot-com bubble 25 years ago and multiple times since. I cannot get terribly excited about it, but that said, stop.
I'm gonna get him in next week.
Talking about eye waffle.
Oracle, from away from the numbers. Hey, good morning to you, Neil. From a technical perspective, this one that you want to trade at if you are going. There are mixed signals here. So short-term indicators like the 10 to 50-day moving average, just going to whack that up, and you can easily do this on the IG platform. You can see here that the over there are starting to cross there, and we're starting to see price action averages, so have caution there. And a long-term moving average, 100 and 200-day buy signals there. So we have a bit of a mix there. I'm going to put that up for you as well, showing us, you can find it under, this is alpha. So RSI indicator there near that 35. It's now around 30, 39, that range, signaling neutral to slightly oversold conditions, which might an opportunity, a buying opportunity if it rebounds. But because there are mixed signals, because we've come from a big leg up since April, all tech stocks largely have done this, I would proceed with caution. Of course, Oracle, the key thing here to watch out for is its cloud infrastructure revenue. Sort of
later.
And we are back. 90 seconds as advertised. I'm Emilio Spivak in San Francisco. That's Jamal Chandler in Chicago. Chris Vecchio from New York will appear on your screen at some point. Stay tuned for that. He'll no doubt take me to task over something. Sir, how goes it?
I'm good, man. I'm good. I mean, it's an exciting time of year. Football's starting up. That's pretty awesome. Kids are back in school. Things are pretty busy. I got a curriculum night at my kid's school tonight. Yeah, you know, I used to feel like that at those things. Now, like, starting when my older two kids that are now in college, starting when they were in middle school, I started saying, I'm going to go to this and just have fun. And I was like the person who was like asking questions and like making the teacher laugh, and you know what I mean? Like, because nobody wants to be at these things. Like, nobody wants to be at it. So if nobody wants to be there, let's just have some fun.
Nobody asks me anything about curriculum, but anytime that there's a parent-teacher conference or something, I'm definitely going in there with zingers, because who's really trying to sit there and just drone on and on and on and on and on? As long as you're there, you might as well have a good time.
That's what I say.
And yes, thankfully, they are back in school. Mine are 4 and 7, and it's been a summer.
Oh yeah, you got the young ones, man. Oh, you got.
I got the young ones.
Yeah, you got.
I got the young ones.
I was talking to a friend of mine the other day. I was like, "Yeah, man, it's I was like, just wait till you get in the thick of it." He's like, "I'm in the thick of it now. They're in kindergarten and 3rd grade." I was like, "Bro, I'm here to tell you that's not middle school, high school. That's when it's really like, yeah."
My sisters are 9 and 11 years younger than I am, so I had a little bit of a window. Oh, but it's going to be action packed. I already know.
Yeah, man. So enjoy it now. Enjoy it while they're young. I know they get annoying, but enjoy it while they're young.
Oh, I mean,
they still listen to you.
They're well. We'll say that. We'll say on air that they do. Their murderous rage knows no bounds. But they are, for all that, excellent. And it's only a matter of time before they outsmart me and spit roast me. And matter of time is like days, not weeks.
Yeah. I resigned to that fact a long time ago.
Yeah, see, there you go. There you go. How do you feel about this reset in the markets today? I mean, we've basically gone nowhere all week. We kind of started soggy. We've come back up to where we started, and we're going into this jobs report tomorrow with the markets basically shrugging its shoulders and going, I don't know what in the world's going on. You tell me.
Yeah, it was interesting, right? Like, we started the week down, which, you know, it just seemed as though like one of those situations of everybody's back from a holiday, long weekend, sell a few things, and even with that, I think we bounced towards the end of that day. Like, I know at one point we were down 100. I think we ended the day down like 40 something and change, which was kind of telltale sign, right? And then throughout the week I feel like we've kind of treaded water, but mostly drifting a little bit higher at times. And then today, boy, I didn't have this on the bingo card. I really didn't to end this much higher, but I think it just tells you the market's a little exuberant about the upcoming jobs report. And by exuberant, there's clearly expecting it to be bad. And you know what I'm saying? Like, it's just clearly that's the situation. It's like, okay, go ahead and show us this bad report so we can go ahead and talk about more of these rate cuts that we got coming down the line. You know what I'm saying?
Yeah. I thought it was really interesting today. So we went all the way sideways into the ISM number this morning. Here it was, the ISM number. It was hot. And you can see how much stocks loved it. But then as soon as that number was out of the way, it was like, okay, let's reposition for NFP, because to your point, heaven's willing, it'll be terrible, and then we'll get these rate cuts. And so it's really interesting here, because you get this tiny little sliver of evidence that tells you in the price action, this market wants bad news, which is kind of an interesting place for them to be. They want this rate cut so bad, but it's pretty much in the market now. I mean, if you look at Fed funds futures as of today, we got a 97% chance that we're going to get this rate cut. I mean, that's basically a given now, I would think. And looking at the rest of this year, we're discounting 50 basis points. Looking at Fed funds futures here, 53. So small rounding error. But the market and the Fed has been basically in agreement since May. The Fed's been saying 50 basis points since December last year, before the tariffs, before any of this nonsense. And the markets have been on this boat since May. So what are we going to get in this jobs report that's not baked in already, in your mind?
Jeez, I mean, I think it's hard to say because I think it's expected that it should be a little bit more showing some more softness in the global labor market. I think that's baked in. I think it's hard to say about the unemployment rate. I don't expect it to go up markedly, but I don't know. It's hard to say. That's a good question. I would say. I don't know. Give me some of the inputs. I keep forgetting. I don't know. You guys, know them better than I do. Unemployment rate, the actual number.
We're going to get the unemployment rate. That's expected to go up to 4.3%.
Which is not market, right? Like, that's not huge.
No.
Right?
No, I mean, nominally, right, it'll be the highest in a few years, but that's because it's been ridiculously low relative to history. So if you look at sort of what 4.3 means here, it would be the highest since, let's say, October 2021. But historically, I mean, it's nothing. We historically average something closer to 6 or 7.
Right.
So okay, we're going to go from 4.2 to 4.3. Oh, no. Not exactly the scariest thing. The other little bit here that's interesting is going to be average hourly earnings, which is basically a measure of wage inflation. And that's the kind of thing that's sticky. We're looking for 3.7 versus 3.9 last time. That would give us basically a comeback in sort of the direction of favoring rate cuts. That would be the lowest that we've been since July of last year. So helpful. I mean, when we dipped to 3.6 last year, before we then went up back on average hourly earnings, that's sort of stage setting then for the Fed said, okay, we're ready to cut at the Jackson Hole last year. And then, of course, in September, they went big, 50 basis points up front, another 50 basis points before year end. It seems to get lost in the sauce in this whole conversation that the Fed already cut by a full percentage point last year.
Right.
And so since it takes about, let's say, about 12 to 18 months for a single rate cut to get factored in, we should be starting to feel that easing like right around now. So I
don't know about you, but I don't.
I don't. I feel no easing. So it's an interesting sort of setup. I'm increasingly looking at what's going on beyond this year because it seems like we're pretty well discounted for this year. But we're going to get this summary of economic projections updated from the Fed in 2 weeks. And I think that's really what this jobs report, at least in my mind, in my kind of convoluted macro thinking, I think that's the story. Because for this year, we know what's going on. Next year, there's a big disconnect. Because in June, the markets got the Fed saying, we're only doing one more cut next year because this inflation risk is what we're concerned about, the tariffs, etc. The markets have 80 basis points discounted. So we're 50 basis points apart. That's miles for next year. And if you get a hot NFP number, even a little hot, for how sensitive the markets are to, here comes the rate cuts. If we get a hot number and the Fed comes out in September and goes, or at least the markets then look at the Fed in 2 weeks and go, wait a minute, they're not going to come our way on the outlook for next year, are they? They're not going to adjust the tally. They're going to say, okay, one cut, that's all you get, go home. And we want 80 basis points. That's going to be a lot of disappointment.
A lot of disappointment. And so that's where I was going next with the S&P 500. We basically, for SPX, just the index purposes, at 6,500 today, right?
Yeah.
That expected move was fairly low. It was 43 when Chris and I were on Futures Power Hour today. So what was that, 3 hours ago? And it came into 38.95 at the end of the day for the move for tomorrow.
Yeah.
And so I decided I was just going to go ahead and put a little something on. I did an iron condor, and I got long an iron condor. I did the 65-35, 65-50, so 15 points wide. And the I might have messed that up. I just realized that. I did 115, but whatever. I guess that works better, actually. I did more to the downside because that's essentially it. I didn't plan it this way, but this actually makes sense. I did it 15 points wide to the upside, but I did it 25 points wide to the downside. The 64, 65, 64, 40. To your point, if we get a hot number tomorrow, the market is not going to like it at all, and we're definitely going to see downside. And so I just made a beautiful accident, but hey, that works.
I mean, it's an idea that makes sense to me. I mean, I've been doing it with verticals. Basically, once we stalled out up here, saying, you know what, we're stalling. Risk reward would tell you vol is obscenely cheap, so you can buy all kinds of puts for basically no money. So why not just do a put vertical up here? If you're wrong real fast.
Yep.
But if you're right, you got maybe room down into here at first, and then we'll see. So like whatever this fuzz is here, and these bottoms somewhere, let's call it 62.50. If you get a pullback even there, the trade already makes sense on risk reward grounds. And if you're wrong quick, and you didn't pay a whole lot to find out. So, why not?
Yeah, this is definitely some of the cheapest that we've seen puts in a while skew-wise. I mean, the market is literally just continuing to go higher. Even dips are getting bought. We saw what happened on Monday. I mean, it's super cheap to buy them right now, but you just haven't gotten the move as often, right? And even if you did get the move, it's not really, Monday was like kind of interesting because you could kind of tell that the market was going lower. Even when we were down 75, I was like, well, this market definitely wants lower, and it wanted to touch the 50-day, which it got close to. But before it even got there, it bounced. And that was it. That was kind of the end of it. And that's the kind of market we found ourselves in. And I don't know about you, but like in the near term, there really doesn't seem to be much fear about anything. I mean, and I think that's what could change tomorrow. If for some reason we do get a hot report, then the fear turns to, wow, we've been expecting all these potential rate cuts based on a bad job market. I know it's weird, people. I know it's convoluted, but I'm telling you, that's just how things work at times. And that would be the one thing that would probably derail things a bit.
Yeah. I mean, I look at this and I go, okay, this market feels like it's not like it's surviving. It isn't thriving. So this was the Magnificent Six excluding NVIDIA.
Right.
Not exactly great. And they all beat earnings expectations. And by some of them, I mean, obviously, Meta, Jesus, it had a 12% day when it beat, and that was here. And it still couldn't make hay of it. So, okay, we get that sell-off. This was the jobs report from that month. Not great. We come back, and if you look at what's happened since then, it's CPI number. Oh, good rate cuts. No follow through. Here's Powell. Oh, good rate cuts. No follow through. Oh, good NVIDIA didn't go completely off the rails. No follow through. So as you look at this, you sort of get the sense that the market is surviving event risk. It isn't finding a way to build a trend. And that feels exhaustion-y, if that's a word that we can coin.
It's just exhaustion with a dash Y on the end, for sure. I mean, do you do dash Y or do you just add the Y? I mean, what's the difference?
I would just do dash Y written, but in my heart of hearts, I've just added it.
So the Russell closed at a fresh high for the year today, as did SPX, and we're not happy on the show. So
No, we're not happy
coming on
the show.
That's what I'm coming into.
No, we're not happy on the show. Have you heard me be happy about this stock market on the show in recent, 24 months?
In recent lifetime? No, not in a recent
Somebody's
lifetime.
got to do it, Ilya. It might as well be you.
I did buy the April lows, but I didn't stick around. In fairness, so when this craziness went down and we stopped falling right here and we got these long wicks here, it did feel exhaustion like on the other side, and I did buy these lows. It didn't last though.
I mean, I look at this market here. What happened at the end of the day, though? Feels like we just squeezed out all the shorts who are getting in line for a bad print tomorrow.
I mean, basically, yeah.
65.12 on the S&P 500. It's not quite a closing high on ESU 5, but the volatility, Jamal, you and I got to speak midday today on Futures Power Hour. Volt came in even more over the rest of the session. IVR on the S&P down from 11.7 to 10.8.
That's exactly what I was just saying before you came on. I was talking about, remember, I'm pretty sure the expected move for SPX tomorrow, pretty sure it was like 43 when we were looking at it, right? When we were on the show. It's 38.90 now. And so, like I was telling Ilya, I decided you had a good idea, I thought, and it worked out even better to wait till the end of the day, and which essentially I did. I actually ended up putting it on as the market closed or right after the close. SPX trades until until 15 minutes after. And so I ended up doing the 65.35, 65.50, 64.65, 64.40 Iron Condor. I told Ilya I actually made a mistake. I didn't realize until after the fact that I did it a little wider on the downside. But you know what? That makes sense. That's exactly what I want.
Yeah.
Because like we said, I mean, if this jobs report comes in hot, market's not going to like it at all, and the downside is where it's going to be at. I'm long them, by the way. I'm long them. So the strikes
are. It kind of feels like it could come in hot. It kind of feels like it could. We've been getting a lot hotter U.S. data over the past 2 weeks. We didn't get an upside estimate on the Atlanta Fed GDP Now forecast today, but it's still miles apart from where market consensus is. I mean, we're at 3% for third quarter GDP. Market consensus is somewhere between 0 and 2, in fact, a little bit under 2. And it's not important whether the number is actually going to be 3%. Who knows? What's important is the model has been taking in data and going up. So the tone of the data is positive. And that's really, I think, the crux of it. I think if the market wants validation of rate cuts beyond this year, I think as we were just talking, Jamal, I think the market is done speculating on this year. I think it's pretty set now. It's next year. And if they get a sense that the Fed is not going to come their dovish way next year, I don't think they're going to like it.
I mean, I guess the question is, how do we trade around tomorrow then? Jamal, I think what held earlier today still holds now. Kicking around that whole, where's the expected move for tomorrow? Now it's only 36 points through the end of the day. And it's a non-farm payrolls report ahead of a Fed meeting. Ilya, that seems lightly priced. Instead of expecting this to be an inside day where you do something like a short iron condor, reverse iron fly, buying the at the money call and put, selling the wings out at the 1 standard deviation move for the rest of the session. It seems like it's a better risk to reward, just given the context of everything that's going on right now. Like, regardless of what the print is, the market's going to move.
Yeah.
That it's going to move away from where we currently are. It's not going to be pinned.
Right.
So we should be trading along those lines right now, expecting us to move away from 65.10. Whether or not that's up to 65.65 or down to 64.65, what have you, that's another story. But maybe Jamal and I were having trouble reconciling this earlier. Why would traders be looking at tomorrow's non-farm payrolls report and not putting it on the same pedestal as Fed Chair Powell's speech last week? Is it because you think this year doesn't matter anymore for the cuts? We're fully priced for what's going to happen. We're on a preset course. Next year's the only game, as you just mentioned.
I think so, and I think it's why we didn't get follow through on the PI number. It's why we didn't get follow through on Powell. They were both good for 24 hours, and that's it. The market didn't have repricing to do. They just got pieces of data that basically said the thing you already know, here's some validation. Let's take a little bit of uncertainty off the table. Okay, now let's take a little bit more uncertainty off the table. And obviously the market doesn't like uncertainty, so when you take a little bit of it off the table, the market goes, hey, all right, this wasn't as bad as it could have been, right? Because anytime you go into event risk, there's the slight off chance that you're totally wrong and the number comes out bonkers. We saw that with the NFP report last month, where the market got something way different than they expected and went, whoa, okay, hold on a minute. And there was a sell-off. And it didn't last because what the markets want is rate cuts. So a bad number isn't something that does lasting damage. But it was a shocker, especially the revisions. And so the market got a little weak-kneed as it was digesting it. But you get a piece of news that validates what you already thought was going to happen, but there's just a little bit of uncertainty that goes away just because you're on the other side of the event risk, and now nothing bad is going to happen. Now you can wrap yourself in your security blanket and go, okay, just wait until the next one. And that's exactly what happens. CPI, jump, standstill. Powell, jump, standstill. Because they already know. They've known since May.
We've known since May, but it's also the environment we're in right now. I mean, the seasonals in August weren't fantastic. If you traded along the lines of them like I did, you got smacked around. And here, if you did so at the start of September, you did pretty well. And then ever since the first hour of trading on Tuesday, it's been basically a straight line up. Volume's
and now
low.
We're basically unched for the week.
Yeah, we're a little bit more than that in the S&P, but I guess what I'm getting at here is that there's clearly positive technical drift again, slope of the 1 month, the 50-day, the 5-day, 1 week. They're all positive and they're all higher, faster pace of acceleration than they were yesterday.
Mm-hmm.
Volume's low. We barely crossed 1 million contracts traded, Jamal. We were at, what, 700,000 when you and I were on a few hours back, and now it's only 1.1 million. So low volume, low volatility. Low volume, low volatility, positive technical drift. Jamal, I mean, I guess what I'm getting at here is this is the kind of setup that we've seen so many times over the past few years where you just got to be long the market and not think.
Yeah, and I truly mean this. Like when I ask you guys, like, well, what's really the wall of worry right now? How many times when we're trading a market day in and day out, and you can name off 3 things, not that could potentially happen, that are currently affecting the market, right? Like there's usually some geopolitical thing in oil going on. There's something, else. I mean, of who knows, whatever it may be. But there's usually like 3 to 5 things, depending on how bad the market currently is. I challenge you to name 3 things right now that are actually currently affecting this market. I think you can only really name 2. It's really rate cuts and it's tariffs. I mean, those are kind of tied together in some way, shape, or form, right? It's almost like it's one. There's just not any geopolitical thing right now that's affecting oil, and the market is really worried about. There's not, a current like war that is fresh, that is new, that the market is fearful of. I mean, this is currently the market that we're lying in, and honestly, that we're lying in right now. And honestly, I think it's I think you either are long, right? Or you're just going to sit out for the time being until things do get, you feel like there's going to be a pullback coming at some point in time, which, I can understand, honestly, both right now, to be totally honest.
Just quickly here, Broadcom, its earnings are out, reported third quarter earnings that beat expectations and provides good guidance, but not much of a change here in the share prices after hours. EPS, $1.69 versus $1.65 expected. Revs were at 15.96 billion versus 15.83 billion. They're also guiding for 17.4 billion of revenue in the fourth quarter, higher than the 17.02 billion anticipated. That means this is revenue in the third quarter is up 22% on an annual basis. Not too bad. Share prices obviously have doubled in the past year. So we'll see how we stay pinned.
Expect a huge move, honestly, after the NVIDIA. I kind of expected this to do what it's doing now. Now, I don't know if they've had the call yet. That might be different, might change things, but it seems like this is par for the course.
Yeah.
I mean, this is very good news to Ilya's credit, right? We're not thriving, we're surviving. I can imagine a data, an earnings report like this. Headline on CNBC right now, as I just scrolled over it. Broadcom reports 63% jump in AI revenue as results beat estimates.
Give me this report last quarter. We probably have the markets uncorking champagne.
Yeah.
Well, listen, there's still time, Ilya. New Year's isn't until December 31st.
I don't know.
Plenty of time for champagne this year.
I mean, a year ago, if we saw that headline, stock would be up 20%.
Yeah. Yeah.
Well, maybe we got the news early today, right? Because you see how the NASDAQ's performed here over the course of the session. It was a relentless march higher into the close, and here after hours, we're holding on to the gains post Broadcom. So maybe we just, you know how these things are. It's material, non-public information, so naturally people are trading on it.
Put a cursor on the ISM release today, because I think we got a little bit of a squiggle here telling us what the market thinks of hot economic data, and then we promptly went on to go, okay, but NFP tomorrow is going to give us our rate cut, la-di-da. But you saw what the markets thought when the data came in hot. They didn't like it. It didn't last, but you got a sense of what the knee-jerk is. And obviously ISM is not the kind of impactful number that NFP is. If NFP is hot, it's going to look different, especially on a Friday with no meaningful earnings to look ahead to, and a Fed blackout next week. They're not going to say a peep next week because we're already setting up for the rate decision on the 17th.
Yeah, the Fed doesn't. Well, do we care about anyone other than Powell?
No.
John Williams, the head of the New York Fed
we
today.
also care about Lisa Cook, but less what she says and more.
And who's staying in her house?
What she borrowed and for what house.
Yeah, that's a good point. I mean, next Thursday, we're going to have inflation data coming in hot on September 11th. So watch out for that, plus the ECB rate decision. But yeah, it's during a Fed's communication blackout window. So we turn then to, I guess, is the Wall Street Journal still our best bet to get insight into the Fed, like Nick Timmeros?
That's what I watch.
Lululemon had earnings too. I kind of forgot about it. I mean, I want to forget about it. I had some calendar calls in there. It's not a huge position, but I was trying to play contrarian on this one, and I just got to say now this stock is probably done, man. I mean, I don't see how it's not. I don't know exactly what they said. I assume something related to clothing and tariffs, but I thought a long time ago their stuff was overpriced, and clearly now the rest of the market does too.
What did Lululemon do today? Lululemon, their shares are down about, what, 13% here?
Yeah, it was up on the day.
They were up over nearly 4% today, but they're down about 13% here after hours. They assume a $240 million hit on tariffs related to their directly for their margins. They say that includes mitigation efforts, pricing actions, and the removal of the de minimis exemption, the company said.
Yeah, that's not good news. If you're shipping little pieces of clothing that could slide in under that, you don't like that.
No, Lululemon does not like that, and neither do investors who are trading the share prices down. You don't see a collapse in volatility here, by the way, after hours, so that's sticking around.
All those drop shippers that tell you to buy their small niche boutique stuff on Instagram, and they go, you know what? Forget Lululemon. These sweatpants are the sweatpants, or these yoga pants are the yoga pants, whatever it is. Those are tiny little baby businesses all around the U.S. The de minimis exemption is their lifeblood. Those businesses don't get it anymore, and they don't have Lululemon's money.
No, they don't. I trust that Lululemon, like so many of these other companies that have had to take tariff charges, right? Like
you saw it in the PPI number.
We know that it's not the foreign. If the foreign countries were paying the tariffs, why would Lululemon have to take a tariff charge? Just let that simmer for the folks that tariffs are not paid by American consumers and businesses.
Right.
Chew on it, think on it. light bulb should be going off by now.
Judge Dredd obviously goes to the foreign countries and collects the money, because how else would we get other countries on their jurisdiction to pay us? We must be going over there with Paulie Walnuts, rest in peace.
But Jamal, like one thing that I noticed this week, and I'm very cynical here. Trump tweeted out that they've brought in $8 trillion between tariff revenue and investments to the United States as a result of Trump's trade plans. Now, obviously, $8 trillion is more than the entirety of all of our trade. So that doesn't seem feasible. But the market is not reacting to headlines like that anymore. And I keep saying to Ilya, it feels like we have this innocent until proven guilty thing going on. Like a boy who cried wolf almost. You know, the wolf is out there making a lot of noise, but he hasn't blown down the house yet. So until he actually does, you got to ignore it. I know that's a sign of complacency, but isn't that the mindset that's succeeded here since Liberation Day?
I mean, essentially it has. And, you know, I don't know the plan of the administration overall, but you can just look at the facts for the most part. The dollar has fallen overall, right? There's all this impetus to try to get a lot of these companies, Apple and all these other, you know, people who do a lot of business overseas to try to come to America, which seems like an insurmountable feat to get production and all those type of things to happen, which is one of the reasons why you see a lot of them going to the White House and having a lot of discussions. You know, I don't know how it ends up playing out.
Discussions.
Yeah, discussions, right? Just one way to call it. There's a lot of other ways to call it.
Shakedown would be another.
But I do wonder, man, at what point it does become enough for the dollar, or at some point, you know, like politics to the side. If there was a real way to actually get all of this investment into the United States, at some point or another, it would turn around the dollar. I mean, at some point or another, right? And so I don't know if that's the desire, that's the want, but I do know, like, the way that we're going right now, it eventually does have, there's a reason why there's so many people short the dollar, and it does have a serious effect on your own currency when you're doing all the things that you're doing overall. So, you know, of course, we know there's been there's been a lot of pushing on Powell and leaning on Powell, I should say, to lower rates. I don't know if there's an inflection point where tariffs and low rates work. I honestly, you know, I know theoretically what happens, but I don't know if there's a way. There's a lot of things that I thought theoretically would happen over time, and especially in these last few years where rates changed, that didn't exactly happen. So I don't know if there's a world where lower rates and these tariffs work, and eventually it leads to a dollar rising again because everybody's investing in America. I don't know, man. I really do wonder. And some part of me thinks that me wanting to get long the dollar is like, maybe that whole thing ends up working. I don't even know.
I'm on the dollar, and it's not because I think the thing is going to work. It's because I think the Fed is going to disappoint these dovish expectations. I also think that the dollar, being a kind of risk-off cash of choice, is going to reclaim that mantle. I think obviously there was a pretty big scare around Liberation Day where it looked like the U.S. was against all advice going to cut off its nose to spite its face. But then when the markets in the president's parlance got yippy and we sold stocks, bonds, and the dollar all at the same time, it seemed like market discipline worked. We got a 90-day pause. We got some backing up off the worst of the foam board tariff rates, and things kind of settled. The dollar hasn't fallen since July. It's been bottoming for a couple of months now, and that's with all the Fed speculation, with all the hopium on these rate cuts. That tells me it might be done. I thought it was really funny that people thought going into the tariffs that the tariffs would be dollar positive for some strange reason. Right. But then, obviously, in the first 6 months of the year, everybody got religion and understood. If you reduce global trade and the currency of commerce is the dollar, less trade means less need of dollars to finance it. So less demand for dollars. I mean, that seems pretty straightforward. So I was short the dollar all through the first 6 months of the year. In fact, it paid for my sins in the equity market. But I'm long now. I think it's done.
So the rationale with how tariffs can be supported for the dollar is twofold. the way that Trump did it is so disruptive that it wouldn't follow this path. But if you were to make a marginal adjustment to tariff rates, in theory, there's fewer American dollars going abroad to buy foreign goods, and therefore we need to convert fewer dollars into foreign currencies.
If that works.
But at this point in time, as Federal Reserve data shows, so that's like the macro theory, the actuality is that 95% of our imports are already billed in USD. So that doesn't necessarily matter.
Because it's
and what you're really looking forward to
is the global currency of commerce.
What you're really looking to is that if tariff rates bump up inflation at the margin, then incrementally you'll have to have higher structural interest rates moving forward to counteract that inflation. And therefore, whatever commerce is lost or demand for the dollar is lost from abroad for recycling, money into our instruments, it's picked back up. It's made up on the other end because we have a better interest rate differential. But we didn't get that benefit this time. Our interest rates went up, and people treated.
To your point.
We might, but the initial reaction was interest rates go up, sovereign credit risk.
Yes.
Right. The U.S. removing itself from the system.
Yep.
Not like, okay, and where we are today.
First recession risk, because the business and consumer confidence surveys turn in February, and everybody goes, these tariffs are awful, they're going to cause a recession. So stocks fall, the Fed outlook gets a lot more dovish, dollar gets absolutely shellacked. Then you get off, to your point, the sort of extreme version of that, the sovereign risk episode. Stocks rebound. The outlook for the Fed never really recovers. It just shifts from rate cuts being mainly centered on this year to rate cuts being centered on next year. And so
Jamal's question earlier today was if the dollar is still bottoming, because he mentioned, we skated through this on Futures Power Hour, and we both said that we would talk about it here with you today.
Yeah.
Where's the best place to express dollar strength right now? Because I'm looking across the board and I see these little inklings, like on a day when yields are lower and gold and silver are getting slammed, the yen and the Swiss franc are getting hurt in a material fashion.
Yeah.
Right. And that's not something that we typically see a lot. It's almost like there's a buy America kind of thing going on. Higher dollar, higher bonds, higher stocks, lower gold prices. And that's ahead of non-farm payrolls tomorrow.
Yeah.
So kind of square the circle with me. What do we get out of non-farm payrolls tomorrow? What do we need to see from non-farm payrolls tomorrow to keep this dollar rally going? And then after you answer that, Jamal, I want to know what you're trading to exercise that point of view Ilya's outlined.
I think for me, what you have to see is a hot number. And I don't think the hot number is going to change anything about what the Fed's going to do in September. But I think
define hot. Because the expectation is 75K.
So the expectation is 75. Let's say we get a triple digit number. I think that would be hot enough. Let's say we get an unemployment rate, because the payrolls number is always a little bit squirrely. The unemployment rate has been the more kind of consistent, not subject to a gazillion revisions, more solid number. And it comes from a different survey. If you want to get nerdy on how the NFP numbers are done, there's surveys, and there's two of them. There's the household survey, there's the establishment survey, and different pieces of the report come from different surveys. The unemployment rate is a steady number. It doesn't get revised a gazillion times. It's not volatile. We're expecting to go up to 4.3. Let's say we don't, and we get 4.2 or even 4.1, and we get a triple digit NFP number without awful revisions. Let's say we get 75, but the revisions are positive, and some of the crazy downstream revisions that we got last time get washed away on second thought. Anything that tells the markets the Fed is not going to go their way in the summary of economic projections in a week and a half, 2 weeks, anything that tells them markets are at 80, Fed is at a 25 basis point cut, and the Fed isn't going to adjust it. The Fed isn't going to even go to 50. Anything like that, and I think stocks don't like it. The dollar rallies. I think the yen is one way to do it, but I think the euro actually is the most attractive because it's got the cleanest top, it would seem. The pound is an interesting one, but for me, the euro is sitting right on range support. It's not rocket science to see where the break is there. I think another one that's been really kind of congested and consolidating is the Aussie. And if you got a risk-off thing, the Aussie would be probably the hardest hit. It's really struggled to go anywhere since peaking out.
Since May.
I mean, it cannot figure a way higher. And if it's risk on, you wonder why, because this is basically the currency market's version of a risk on asset. So if you're going to get some pain, this is another one where it's pretty straightforward. You know where support is. You can see the risk reward. If you're wrong fast, and you get out. I'm not even doing this through options. I'm using micro futures, and I'm outright short M6A, M6E, M6B, MCD, which is the Canadian dollar. On the spot side, I'm long dollar Swiss. I'm long dollar yen. My boat's full.
So Jamal, if we're thinking about still playing dollar strength here and it's weathering the storm, yields going down, Fed rate cut odds going up, it's just been too crowded of a trade for so many people. Where are we playing this view? How are you handling this?
Well, I can just tell you partly from what things that I have on already. So I mentioned the SPX, the iron condor. I mean, it's basically a broken wing iron condor at this point, kind of. And that would work for tomorrow. If that happens tomorrow, that would work for tomorrow, I think. I think we're going to get a move that goes below my short strike is 64.40. I think we get a move below that. We're easily down 60 to 70 handles from here. I am, to Illy's point, I am long the dollar via that euro trade. I am long a put spread in there. And this is part of the reason why, besides the SPX trade, I felt like I kind of had to do it because of different long deltas things that I have on. But this is part of the reason why any big macro trade that I have is further out than October. Because, this talks about silver, I'm talking about gold, I'm talking about the dollar. Because it's really kind of, things aren't exactly fully making sense right now in some way, shape, or form, right? And so because of that, I think you just need a little duration on some of these things, particularly when you're talking about the dollar. You know what I mean? So that's why I have a lot of those out there. But I got the put spread in the dollar and the euro, excuse me. I got the only near-term real macro trade, if you will, I have is that SPX iron, the SPX iron condor. And, I have... I like I said, the other thing that's going to happen is gold and silver would probably get whacked tomorrow, which would suck, but I think it'd still possibly be in play. It just depends on how bad this situation is. I think the biggest thing that they're holding on to, obviously, is rate cuts at some point. So obviously that's going to dampen that some, but will it kill it all the way? I don't know. It would be interesting to see if this 90% expected rate cut drops below 50%. I mean, that would be something else. That would be pretty wild with, less than 10 days to go for this meeting. So it's the euro. If I do decide to do another, way to get long the dollar, it's probably yen at some point. I mean, I don't know if I'm going to do it right off. But I'd rather express those opinions in that way. I know a lot of people, we often talk about UUP on this network. I don't really like that as a product, honestly. I think it doesn't move the same way, and it's not the same exposure, right? It's just not the same as dealing with one of these currencies. One of the things I wanted to ask you guys, and I know we mostly use probably micro futures, but I was just looking through, and I noticed this today on the show, and that's why I teased the idea of talking about the dollar, Chris, at the end of the show on the Futures Power Hour today. But looking at these futures, it's interesting to me that when you look at margin on all of them, right? Aussie, whether you buy or sell, it's the same. The only one that's different is the euro. It is way more expensive to get short the euro than any other of these currencies. I wonder why that is.
Theories?
I don't recall the CME changing margins.
Well, just look at the buying power for getting long and look at the buying power for getting shorted.
Yeah, the euro is expensive relative to the others.
But I mean, just saying within the euro, it's not even the like for yen, it's expensive, but it's equivalent whether you want to buy or sell. For the euro,
yeah,
it's like twice the amount of margin to sell versus buy, more than twice actually. I just find that interesting. A lot of times, when you talk about changing margin requirements, we know it's because it's an interesting trade, to be honest with you, right? When gold was really going, they raised their margin requirements. We know how that goes. It's just kind of fascinating to me that it's higher margin.
Yeah, the margin's like 23% bigger for going short than going long right now, just outright futures. I mean, is that an artifact? I actually didn't see this earlier today when there was more liquidity. Is that an artifact of where we are during the day, or is that something you've noticed recently?
I just noticed it today, and I'm just curious if it's one of those situations where there's just that many more people that are shorted. I don't know.
I haven't noticed that the margin is different in either direction, but I've definitely noticed that the euro is more expensive. I think that's probably a function of volume. It's sort of generally relative to other currencies, but the difference in buying or selling, that's interesting. I haven't noticed that until you've just mentioned it. I wonder.
It's an incredibly crowded trade still. Like the Z-score for the euro, looking at positioning in the futures market for speculators, is still north of 1.2, so 1.2 standard deviations above its 20-year average. I mean, like, look, Jamal, I think this is worth bringing up for this crowd here too, thinking about always going back to what's the trade. One reason why the dollar may have a little bit of a better time ahead of it is because of what's been happening in gold and silver. You and I highlighted earlier today periods when gold or silver had exceeded certain percentage thresholds above its 1 month moving average, just a trade getting too long in the tooth. Some of these other episodes when silver's been 5% above its 1 month, when you've seen that same type of price action in gold, right? Just getting stretched. Where have we seen this recently? Well, we had it flash yesterday on September 3rd. Prior to that, you have to go back to June 9th, okay, for silver. This is gold up here, but again, thinking about both charts, behaving similarly. What happens after June 9th here? Gold is just moving sideways. It's not rallying. We have to go back to February 4th, which in early February, you get your rally in gold and silver, and then it basically does nothing for the rest of the month. Before that, October 22nd, 2024, I think silver emphasizes this a little bit better, but you have one of these dates right here, right? So silver does nothing for the rest of the month. October 22nd is this date. What's the point of me bringing this up? When gold and silver get into this realm, 5-7%, above their 1 month moving average, they tend to be at a place of resistance. They've gone too far too fast. It's time to slow down and catch a breather. And so if these guys are going to catch a breather right now, then it would stand to reason that even in the face of those lower yields like we saw play out today, the dollar is probably well positioned. And then we think about all the themes that have worked with us over the past several months, especially since April 2nd. The buy America, sell America is the one that sticks out most because you have that alignment today. The gold down, the bond yields down, dollar up, and stocks up. So I would just wonder for tomorrow, if we get a Goldilocks print, it's 65K, 75K, 85K. It's weak enough to justify rate cuts, but not weak enough to make people think we're sliding into imminent recession. That's exactly where the stock market's going to want it. You're not going to get more cuts priced into the curve, Ilya, so the dollar could have a chance to rebound. Plus, if we get one more cut priced in for this year anyway, I mean, how far away are we from it? 60%. So it'd be a little bit more dollar weakness. And then, so like the bottoming process could continue. We don't need to price in a full cut. We have to add half of one back in basically. I'm leaning long bonds. I'm leaning long stocks. I'm long the dollar tomorrow. I'm still long silver. So I'm ready to go. I mean,
I was just thinking about that. Okay. This is the one thing I do want to know. Tomorrow, you just said long, because I'm long the same. Like I'm long stocks, I'm long bond. I'm not long bonds right now, but I'm long stocks. But let's just say long stocks, long bonds, long gold. Let's just put gold and silver in the same, and long dollar. Which two disappoint tomorrow? Stocks, gold, dollar, bonds. Which two disappoint?
Gold is going to disappoint me tomorrow. I'm long gold, I'm long bonds, I'm long dollars, I'm short stocks. I think gold is going to make me suffer tomorrow.
For my sake, I hope stocks also disappoint Ilya. Because of how you're usually on the opposite side of the table.
That's been the story since the beginning of the year. Thank God for cheap vol and verticals.
Jamal, you're not here with us that often. You have the final word as we close out this week. Overtime's going to be back next Monday. Dylan will be back with us. What say you for this trading week as we make our way through the first week of spooky September?
It was a really good week, and I'm not going to lie, I'm worried that it might turn, and I'm worried that stocks fail, I'm worried that gold fails, and I'm worried that bonds fail. And that's going to set up the rest of the month being really, really wacky.
Eagles Cowboys are playing tonight. As a New Yorker, I'm rooting for a meteor to hit the stadium. And with that, overtime is out of time. We'll be back on Monday, same time, same place, 4 p.m. Eastern, 3 Central, right after last call. So for Ilya Spivak in San Francisco, Jamal Chandler in Chicago, I've been Chris Vecchio in New York. Good luck trading. Brief break. Tasty at Night coming at you. Ilya Spivak with Macro Money up next.
See you there, everybody. Well, the markets are finding a little bit of solace here as we head into the end of the week, a little bit more chipper from Wall Street at this point. But will we get some validation? That's the question we're asking ourselves here on Macro Money. I'm Ilya Spivak, head of Global Macro here at Tasty Live, and we are within striking distance of what is perhaps the biggest piece of event risk for the week, and certainly the one that we care most about as macro type folks on this show. And of course, we're talking about U.S. jobs data. And what we're going to do here is we'll take a look at what all of this might mean. We'll take a look at what happened in the markets going into this situation and see if we can't break down what this is going to mean, and more than anything, ask ourselves, what is the reaction function in the markets here? What is it that this data is going to do that's going to make the markets happy? And what is it that that this data might do that is going to give investors something of a pause, some indigestion? What could they look at that would be a disappointment? And see if we can't figure out which way this thing is likely to lean. So first, let's just consider how the markets did today. It was a nice day for Wall Street. S&P 500 up almost 0.9%. NASDAQ managing to round out the full number, up 1.01% there. Yields down across the board, so markets seemingly setting up for this jobs report tomorrow. 10-year down, 2-year down. Crude oil still marching to the beat of its own drum, doing not much of anything. Gold pulling back a little bit. It was a much bigger loss, but if anything, this really gives us the sense for what was going on here today, because gold really didn't have a very good reason to be going down on a day, or at least it would seem it wouldn't have a very good reason on a day when bond yields were off 1.4% on the 10-year and off nearly 0.9% at the front end. So gold more so looks like it is in some kind of a consolidation situation ahead of what is, of course, critical event risk, rather than anything that seems to say, oh, we're going to end up with some kind of an outcome on this jobs data that is going to be untoward. Instead, it seems more like we're looking at gold that's been surging up a storm here, hitting fresh record highs and doing it in explosive fashion over recent days. As we get into this event risk, the market just wanted to get a little bit of that speculative froth off the table. At one point today, to sort of give it a sense, gold was down 1.42%, and it finishes the day obviously with a much more modest loss. So it seems like we're looking at a situation that's more corrective than it is direction flavored. Bitcoin down 1.9%, dollar a little bit stronger, up 0.1% against the euro, up almost 0.4% against the yen. So kind of a hodgepodge, not really a strong directional lead here. But as ever, if we look at the way the markets have performed week to date, we see that Bitcoin's recovered a little bit, up 1.75% after last week's brutal, nearly 7% sell-off. So on the whole, Bitcoin obviously meaningfully lower than it was a week and a half, 2 weeks ago, but it managed a little bit of a baby recovery. The dollar continues to strengthen. Last week, the strength was modest. Now it seems to be picking up, especially against the yen. The surge in gold, of course, continues. It surged last week. It's continuing to do so this week. Basically a wash for crude oil. Last week up a little bit, this week down a little bit. It's still oscillating in that familiar range. Rates are the big story this week, where things are heading meaningfully lower there. And of course, last week, more of that. So that's a trend that continues. And stock markets had a bit of a soggy showing last week, and at least so far, it looks like we're getting a little bit of a recovery, but of course, we're still in these familiar ranges on the major indexes. We haven't really gone very far at all since almost a month ago. And so it's an interesting sort of setup as we go into this event risk. Before we get there, though, a little bit of a note about what happened here overnight and into this news that we just got today in the U.S. session. Of course, the number we were watching closely was this service sector ISM number. And yesterday on the show, we talked about how the tea leaves suggested we'd get an upside surprise, and we got that. 52 versus 51 expected, a meaningful pickup in U.S. service sector activity growth, meaningfully more positive than the markets had on their bingo card. And if we look at the internals here, we can see this is not dissimilar from what we had on the manufacturing numbers, that part of the survey, which we'll take a look at in just a second, earlier in the week. So overall, for the service sector at 52, we're looking at the fastest service sector growth since February. So this is a meaningful recovery here. Never mind that it's better than expected. It's fairly chipper even in absolute terms. We see that we get a little bit of a dip in prices, although inflation is still very elevated in the service sector. On the employment side of things, we're still contracting. So this is, of course, in the logic of PMIs, where 50 is neutral, above 50 is growth, below 50 is contraction. The further you go above 50, the faster the growth. The further you go below 50, the faster the contraction. And here you can see we get this new orders number coming up from basically standstill to strong orders growth. This might line up with evidence that wholesalers are starting to pass on inflation costs to consumers, and margins are expanding back out again. Employment still in contraction territory, but at least it didn't get worse. So the pace of employment contracting did not accelerate, as it were. We likewise had a situation on the manufacturing side earlier in the week where the price decline has been a little bit more consistent. And of course, here the tariffs are much more front and center because this has to do with goods. Services are mostly serviced domestically. And here you get a very clear view where the price component is coming in, and so new orders are up, though employment again, still in contraction mode, but at least it seems to have stopped falling. The final revisions of S&P Global's version of the PMI data, not really meaningfully different from initial estimates, a little bit softer on the composite and the service sector numbers. But again, even looking at this, the mix is a little bit different. The survey construction is a little bit different from the ISM, as is the timing of the surveying. But you do get the sense here that the U.S. economy seems to be on a path toward reaccelerating over recent months. And it's not quite so dramatic in ISM, but you are starting to turn. And of course, the service sector is the biggest one of the bunch. It's close to 70% of the overall economy, and more than that of overall employment, closer to 80%. And so there does seem to be this sense that the U.S. economy is starting to find some more momentum. And it is with that we go to this U.S. jobs report that, of course, is going to be the biggest piece of data for the week. And perhaps the most interesting bit here seems to be that we're looking at a situation sort of fundamentally where the markets want bad news. Now, they don't want catastrophic news, but what they don't want is anything that upends rate cut expectations. And we saw it with the ISM today. It wasn't lasting. The markets clearly didn't want to have any kind of directional conviction as the NFP number gets closer. But if we take a look at what the markets did today, when that ISM number came out, and it came out hotter than expected, we promptly fell across the major indexes. And we managed to hold the downside for maybe about 15, 30 minutes. But it was a significant sell-off. It took us down to the lows of the session before we rebounded. In fact, if we were to take a look here at what could have been perhaps were we not looking at the NFP report that's immediately in front of us, we might have been looking at a meaningful decline. The overall size of the swing from where the data printed and into the daily lows was not the worst, but not nothing. We declined close to 0.2% just in about 20 minutes time. And it was from there that things started to really ratchet up in an almost straight line to give you the sense that the markets just wanted to get on the other side of event risk and get ready for what this is going to be. The expectation is 75,000 jobs added. The unemployment rate going up to 4.3. Nominally, that's the highest since October 2021 or so, but obviously historically, the unemployment rate has been much, much higher, and the historical average is meaningfully higher. It's closer to 6 or 7. So 4.3 isn't high, but it's high relatively speaking. And you can see here the trend has been for a cautious increase for a while now. The trend in job creation has been for a cautious decrease in the magnitude of gains for some time now. The 75K number would be a slight improvement over 73K in the prior month. And the logic here seems to be, well, the markets want anything that doesn't upend rate cut expectations. So what would need to happen here? Now, the lead-in, we got a bunch of jobs data today to give us a sense. The lead-in is a little bit soggy. The 4-week average for jobless claims we can see has been climbing. In fact, we're now sort of into June levels here, give or take. We got the ADP employment report. That's a private sector payrolls estimate. It doesn't line up very cleanly with NFP, so don't take this as gospel by any means. But the expectation was for 65K, and what we got was 54. So not the upside surprise one might have been looking for here. We're one to look for that, and the weakest number that we've seen since May. That's here. But nevertheless, the trend for U.S. economic data, and we said this ahead of ISM yesterday, it's been increasingly rosy. So this is the Citigroup Economic Surprise Index, and we can see here the zero line is where you separate upside surprises versus downside surprises. Under zero, you're surprising on the downside relative to forecasts. On the upside, you're surprising higher. And of course, this is sort of whatever the expectations are for any given piece of data. If it surprises higher, the index goes up. If it surprises down, the index goes down. And it's scaled by the more market moving things. So when the move is big, the index moves more. And it gives you a sense for where outcomes are relative to economists' forecasts. And we can see really since July, we've seen data that's been tending to outperform relative to forecasts. And especially over the past 2.5 weeks or so, the data has really pounded upward. And at this point, we're at some of the highest levels that we've seen since back here. This is sort of the second half of last year. And so the tendency isn't so much for data that's good. That's not what this is saying. It's for data that's better than it expected. And of course, ISM was a case in point today. Moreover, the Atlanta Fed's GDP Now model, never mind what it actually says for third quarter GDP, it'll be a while yet for that number to look like anything that approximates real results. There's a ton more data that's going to go into it. This is not a forecast, it's a nowcast. So it's constantly taking in new data, and the model is adjusted sometimes on consecutive days. The important thing is here's the model, and whatever data it is taking in has been increasingly positive in recent weeks. Not surprisingly, going back to about the same point here as what we see here. So this and this is telling us U.S. economic data is getting rosier. Now, what might this mean? Well, ISM today, again, is a case in point. It doesn't mean much, probably, for near-term policy expectations. The markets get only more convinced today that we're going to get a rate cut in September. 97.4% chance that that cut is coming. But the bigger deal seems to be the disconnect thereafter. So once again, if we take a look at where the markets are versus where the Fed is, we can see the markets have been basically anchored around 50 basis points in cuts since around May. There's been a little bit of a wiggle on the downside, a little bit of a wiggle on the upside, but nevertheless, this is it. We've been basically pinned here. And that lines up with the Fed's own forecasting. This is the latest summary of economic projections, and we can see the Fed's been saying 50 basis points. They said it in December of last year. They said it again in March. We can see that here. They said it again in June. The current median for the Fed funds rate is 4.4. Down to 3.9 is 50 basis points in cuts. So the markets and the Fed, they're aligned. There's not a whole lot of speculative juice here. The markets know what's coming. The Fed's only got 3 meetings left for the year. They're almost out of calendar. There's only but so many ways you can slice and dice 50 basis points over 3 meetings when you already know that one of them is coming in September. So either we get another cut in October or we get another cut in December. It doesn't much matter. The larger issue here is that for next year, there is a vast disparity. The markets are at 3 rate cuts, 76 basis points with 75 in and 1 basis point of rounding error or something of the sort. But we can clearly see here, 3 cuts are fully discounted. Look at the Fed's calculus, and we go from 3.9 to 3.6. That's a 1 cut forecast. So there's clearly a big difference here. The Fed thinks they are not going to be able to do nearly the stimulus that the market thinks that they are going to be able to do. And so this is where an upside surprise on the NFP number would be most unwelcome. Because if we then take a look at what would happen, I mean, chances are we're so baked in for this month's outcome that we're probably not going to get very far. Let's say you dilute the probability from 97 to 90. Let's say you dilute it from 97 to 87, even lower. It would be some kind of a minor catastrophe if you had to dilute the probability of the September move somewhere back below the 50 mark. So we're going to get this cut. And chances are we're also going to get the 50 basis points that the Fed's been talking about. The markets are there. The Fed is there. It's probably a done deal. The larger issue is this disparity and what the Fed says in the summary of economic projections. Now, does this disparity matter? Well, it would seem to. Here is the S&P 500 against that rate cuts outlook, and we can see how this has developed. Here's the beginning of the year. This is mid-February, where the markets initially start to worry about the tariffs because business and consumer confidence surveys tell us that nobody likes these tariffs and they're all expecting it to be a growth risk. So expectations get more dovish. Stocks fall. Obviously, the crescendo there is Liberation Day in early April. Then we get a little bit of fuzz while the White House walks back the worst of their assaults on the market's kind of infrastructure. For a while there, it looked like the administration was going to, despite the tremendous benefit that the U.S. reaps from a dollar-based and a U.S. Treasury-based financial order, that they're going to upend those norms. And despite all logic, cut off their nose to spite their face. But that isn't ultimately what happens. The administration actually shows that they are responsive to market discipline, that when the markets get, as the president said, yippee, they back away. And so we very quickly get a 90-day pause on tariffs, and the markets go, oh, okay, this is not what we thought. This is not a reason to get hysterical. This is not the end of the U.S.-based global financial system. And so stocks obviously recover. We come off the lows a little bit relative to policy expectations, but notice what happens here. This is May. This is where the markets anchor around this 50 basis points that the Fed already told them is coming. Then the outlook starts growing increasingly dovish again, and we're almost back at these lows. And so once you kind of recover back to within earshot of the starting line on this sell-off, the dynamic changes and stocks start powering higher as the outlook for easing for next year grows. And so it's very easy to conclude here that much of this vigor is rate cut speculation. Interestingly enough, when you look at the way the dollar has behaved, it sells off with gusto when this is starting to adjust down. it never really rallies like stocks do on sentiment grounds. But even as we get more and more dovish on the outlook, as of the beginning of July, it stops falling and has been attempting to carve out some sort of a bottom. This is not a currency, seemingly, that wants to decline. And so we end up with a situation where we have the possibility that the jobs data surprises higher, the possibility that it undermines the case for all these rate cuts, and a dollar that's looking for an excuse, seemingly. And if rate cut bets get diluted, then it's got that excuse. So the way I'm positioned here, just to take a look at what I have on, and you can see this in the Tasty Trade follow page where all of these positions are posted. So I'm long the dollar here. So you can see I'm short the Aussie, short the pound, short the euro, short the Canadian dollar. I have a long-standing long position. You can see it's got until the end of the year in Brazilian stocks. That's more of a thematic thing, but not surprisingly, I'm short some puts in gold, short a vertical here with the breakout. But the core of the idea here is this. So some puts in the NASDAQ, some put verticals in the S&P, some negative exposure in Bitcoin, basically looking for that to be a sort of leveraged risk-off move and a move reflecting strength in the dollar, so tilting the boat even more that way, but long the long end, again, via verticals here with still a little bit of time left. I've been sitting on these things for 60 days already, but I still have them. You can see here we have calls at 86 and 87 with the vertical cap around 95. And the idea here is if you dilute the case for rate cuts now, perhaps more of them migrate down curve. And the long end actually sees yields go down as a consequence of fewer rate cuts occurring nearer term and the market's getting disappointed. So stocks lower, Bitcoin lower, gold is a structural move that probably doesn't care all that much. It's been surging this week despite strength in the dollar, and that's seemingly disconnected from the narrative. So just looking at the price action there with plenty of duration at 43 days, but otherwise betting on a higher number that gets the markets in a bad way. And that is macro money for today. As ever, we are here Monday through Thursday, right after overtime, a show I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and where things may go therefrom. Writing for the news and insights portion of tastylive.com, commenting at Ilya Spivak on former Twitter and on Blue Sky. If you're watching this on YouTube, like and subscribe. Macro Money's back next week. Happy trading.
Welcome back to Risk of the Week. It's been a pretty volatile day. We've been bought straight back up since the sell-off, and then we got NFP to worry about tomorrow. Before we get into all of that, Gus, my brother, how are we doing today?
Doing good. It's kickoff of the NFL season. One of the best days of the year for me. I mean, not as good as opening Sunday, I suppose, but I got my Bengals gear on. I'm here repping, and it's exciting times.
I gotta say, every time
not a good day in the market. I will add that. But the vibes are too high.
I don't know. We had such a massive rally later into the day, and I would have thought things would have reacted a little bit differently because of that. But before we get into that, the Bengals. I seen the Bengals today on the chest, and I was like, this guy's a Bengals fan. I forget. It throws me off every single time, but I can respect it. Ocho Cinco.
Yeah, Ocho Cinco. That's a good pull. Yeah. What you know about TJ Hushmanzada?
Oh, that's my guy. It's like TJ. Got him on.
But yes, Bengals and Reds for me. Cincy teams, as far as Cincy teams extend. And I will also add that if Cincinnati gets teams in other leagues, they will override my existing fandoms in other leagues. But right now it's just MLB, NFL. So Reds, Bengals, Rockets when I moved to Houston. Predators, NHL. I was born in Nashville. I got a claim to them, and I've never lived in an NHL city until now.
You were in Nashville for how long?
Until I was 4.
Okay.
Yeah. But yeah, moved to 2 non-NHL cities, and then I kind of got into it in like high school and college, and so I just clung on to Nashville. That was what I had to
Saved by
tie
the
to.
bell. You could have been a Titans.
Yeah, exactly. I was a passive Titans fan for a little while. My parents were big fans, but I've settled in with the Bengals. But yeah, we look. I don't know. The defense has got some question marks, as has been the case the past few years. But we'll see.
Hey, on the football talk, real quick. Saquon Barkley. He's an investor, right?
Yeah.
You learned a couple things about him.
We did, yes. Errol and I, I stumbled into some research today that led Errol and I going down a Saquon Barkley investment rabbit hole. You guys can Google it for more detailed information, but the dude is a financial mastermind. His rookie deal was $32.1 million up front. He put all of it into the S&P 500 and said that for his first year in the NFL, he was just going to live off of his endorsements. So that's something like 4 or 5 years ago now. That's been growing nicely this entire time, that $32 million. The next year, he got $10 million in cash, and he put all of it into Bitcoin at 32,000, which was a very smart play. And then the following year, he put 500,000 into Anthropic as an angel investor. That investment is now 20x'd, and he's an angel investor in like 6 or 7 other companies as well. 3 of them have already 10x'd his investment. So yeah, Saquon Barkley, Eagles running back, real financial guru, and it's really refreshing to see. And I feel like that's growing in prominence. These guys like really caring about their money and doing, managing their finances the correct way. I suppose you got Tyreek Hill, who has, I think, 12 kids with 10 different women now.
Oh, is that what it is?
Yeah, he keeps...
Young boy never seen. I thought that was young boy we were talking about for a second. You don't even know.
I'm going to fact check this because I don't want to speak ill on the man, but he has numerous children.
No, I love it though, right? One of the top athletes.
This article literally says at least 10 children.
At least. Okay.
Figures range between 7 and 12 confirmed children, with more speculated. So yeah, that's not a very financially savvy move there. But this is a growing trend that these guys are really trying to manage their money correctly and genuinely, build generational wealth, not just live lavishly for the rest of their lives. And so, I think it's really refreshing to see. Somebody tell Saquon Barkley he needs to be watching tastylive.
Yeah, no, I mean, I love that, especially because Saquon is one of the top, if not the top athlete right now. Saquon Barkley, I mean, with this spin, I don't even know what you call it, spin jump behind the back, whatever you want to call it. I mean, he made the NFL cover.
Yeah.
So a lot of young people are going to see that cover, a lot of these younger people, and they might get inspired by him, start looking into him a little bit more. Oh, yo, he's financially savvy too. And that goes a long way.
Yeah, he's a star, and that's absolutely the types of role models that you want these kids to have. You don't want you don't need to be clubbing and
you don't need young boy all the time.
mansions
Young boy's music is fire. You don't need all the young boys.
Yeah, exactly. I like Green Dot in the gym as much as the next guy.
I'm not gonna lie, you're so valid for your music taste. Every time it catches me off guard, I'm like, Gus is valid. But anyways,
thank you. Big deal. You're a Titans fan. Good to hear. I would still say the Titans are like my second team. Like if the Bengals were ever in a situation where they were eliminated and the Titans were still around, that's who I would switch to rooting for. And I'll tell you what, I'm higher on the Titans than most this year. I think they got a chance to sneak into the playoffs. I like Cam Ward more and more the more that I hear from him. And I do have a Titans to make the playoffs future at something like 4 or 5 to 1. But I think the Titans could be a surprise this year. I don't think they're going to be contenders, but I think they could be a surprise.
So they're not good enough.
It's like, well, there's levels of progression. When you're rebuilding, there's levels to it. So you gotta take the wins where you can get them. But anyway,
American Eagle.
We
got a new slide for today. We can go ahead and jump into the slides.
Yes, American Eagle. We might as well be sponsored by American Eagle at this point, but we just got to keep talking about them because they will not be quiet. The run only continues for American Eagle. They had earnings. Was it last night post-market or this morning pre-market?
Let me double check.
Irrelevant. Between when the market closed yesterday and when it opened today, American Eagle had earnings, and they reported incredibly strong numbers. We can jump into this here. Huge gap up, and this is incredibly interesting. We'll get into the nuance here, but this is incredibly interesting because this earnings call proved that the Sydney Sweeney thing worked. This is putting into the actual finances and numbers something quantifiable that this actually works. There was these run-ups on hype on these great ad campaigns and all this, but none of that is actually substantiated. And we talked about how crazy it is that a company could move up. What was it on the Sydney Sweeney thing? Like 17% on.
It was 25 to 30.
Yeah.
25 to 33%. You're talking about last night or before the bell today.
No, I'm talking about like
the previous one
when the Sydney Sweeney thing originally dropped.
Yeah, that one was a little smaller, like 8. I think
it was like 1150 up to 13,
somewhere around
like
there.
that. So yeah, like a 10-ish% move, just from an ad campaign, and that's really, really interesting to see that they held on to those gains until this earnings call, because usually the hype cycle is exactly that, a cycle. It gets hyped up, we get the run up, and then things fall right back off. But that has not been the case with American Eagle. So just to quickly recap the timeline, Sydney Sweeney has Great Jeans campaign in July. We covered that here on air. Stock moved up about 10% shortly after launch. There was all kinds of backlash, but really the backlash wound up working out in a very positive way for them. They spun the, there's no such thing as bad publicity sort of mantra into absolute truth.
I think they played it perfectly.
Yeah, I don't think they could have done a better job, and I think it was really smart of them to double down on it when they did. We talked about it. If you're in a controversy, either double down or stay quiet. Right. But you cannot apologize.
Again, I think people are learning. Like I think marketing, when you have the masses' attention, is beginning to become more of a skill everybody's more aware about. Again, Cracker Barrel, again, I feel like we keep talking about the same type of topics, just a different underlying. But I mean, Cracker Barrel, again, they got a lot of the heat, they got a lot of attention, bad publicity, good publicity, whatever it is, and then they made a move that ended up capitalizing on that attention. American Eagle, I mean, they had to foster, we were just talking about Taylor Swift's husband the other day.
Taylor Swift's fiance?
Taylor Swift's fiance the other day, and that was with American Eagle too. They've really just been riding this wave ever since they dropped Sydney Sweeney.
Yes, absolutely. It's a legacy marketing run, and they have managed to turn it into actual tangible results. Like we just said, they beat their EPS they beat consensus estimates for EPS by 112% in this earnings call that just happened, which is very uncharacteristic, especially for a company that is I shouldn't say as public, they're all public, but as established and, rounded and has been in the market as long as American Eagle has, you seldom see triple-digit surprise EPS beats from companies like that. Yeah. The market has reacted accordingly and moved up another, 25 to 33% today. On the news, you can see the chart here, which Errol so wonderfully removed the background.
Bro, I was looking at this again, and I was like, yo, look at that white background chart. It's fire. I was just looking at it.
Yeah. It's really interesting. And I've honestly never seen anything like it. And
were you surprised, though? I got to ask.
Was I surprised by this earnings call?
Yeah. Were you surprised by the jump, the velocity?
I'm not surprised that it was a beat. That's what I was expecting. And I was expecting these numbers to be really good and the stock to maybe move up a little bit more. Like, I did think that this was going to substantiate. But to this degree, no. I was not expecting this.
Yeah.
112%. And they beat revenue by something like 20 or 30%.
No, they gapped up and kept running.
Yes. And that's the craziest part is they gapped up just on the ad before we even knew anything. Held the gains, gapped up again just on the next ad before we do anything, held the gains again, and now we've made another leg up. I don't know the last time that in this short of a time, in 2 months, someone has managed to kind of surge back into relevancy this hard, add this much to their market cap, save for the Palantirs and Nvidias of the world and occasional penny stock. But to get a legitimate, substantiated move that seems like it's going to hold to this degree, I don't know if I've ever seen anything like it. And it's all because of marketing. They didn't release a new product. I guess they released Travis Kelce's clothing line as a part of that, but it's not like they've revolutionized clothing here. They just had excellent marketing.
Yeah. No, I think American Eagle is going to be kind of a nice, fun post-earnings kind of idea / play heading into tomorrow and the rest of the week.
But and Macy's had a good earnings report in chat as well. I guess good day for the clothing manufacturer.
What is what's the ticker for Macy's again? M. There we go.
They've been around. They've been around. They got one of the 26 single-digit tickers.
We can go ahead and jump over to the platform here, and we'll do a little tour to market, a little rundown, see what we're looking at ahead of NFP tomorrow. The market volatility just absolutely collapsed today. It was just dead midday. So some American Eagles earnings spicing it up a little bit here.
Yeah, and I think you make a great point too with the fact that marketing is just getting more savvy. I saw something recently, and I think this is so brilliant.
What was that?
Hershey's is doing a campaign right now to promote women. I don't really know a better way to phrase it than that. They're doing a pro-women campaign, and so they're selling.
All right, go ahead. Keep going.
Google Hershey's women campaign.
Yeah, I got to.
But the tagline of the campaign is "Celebrate She." And on the Hershey bars that they're selling as part of this campaign, she in the middle of the bar, like the SHE, is highlighted in yellow or blue, and it's like very prominent.
Oh, I see. I just see it right now.
Celebrate she. Cool. And I saw somebody post this the other day, and here's where I think this gets brilliant. I saw somebody post it the other day and say, Hershey's is so stupid. Her is right at the front of the word. Celebrate her. It would have worked so well. Why would they choose she? And I think that Hershey's is rage baiting.
Yes, the rage baiting.
Yes, I think that this is calculated rage baiting from Hershey's, and that they knew that people would see that and get mad and tweet it exactly like the tweet I saw today. And I think that is so brilliant.
Yeah,
I'm blown away. And I think it's amazing these companies, these huge publicly listed companies, are actually getting smart enough and savvy enough to rage bait.
Wow,
it's like
we came to the day, so now we're using psychology in our marketing. Wow.
Yes, and it worked. And I'll tell you what, I went scrolling through those replies, and not one person pointed this out. Everybody just said, "Oh yeah, it's right there, Hershey's. So they're so stupid." Oh, that picture never hits Twitter if it's her. No. You would just brush right over it. It's brilliant. It's brilliant. So I think that's great. Yeah, I mean the rage bait. It just works. I'll float this. I told Errol ahead of time. I posted a TikTok the other day with some intentionally slightly shoddy economics with this exact same thesis, and it panned out beautifully. Everyone got mad at my economics in the chat, and the video performed well. This rage bait stuff is real, and I'm not necessarily endorsing it, but it feels like, and especially with a brand like Hershey's shifting over to it, it's almost like this is like a survival tactic at this point. This is what everybody is doing, and I hate it. I will say I don't like it when I see it on social media. It's annoying, and it's becoming too prominent, but it's very effective.
No, it's funny, we were having that conversation earlier today, but to see it done at that scale of company, it's like you're really gonna rage bait your audience.
Yeah, it just works, and especially in the case of Hershey's, like that's just a pure like brand recognition, like get it gnawing at your brain. They just want you to see that on Twitter, and then a little bit later you're thinking, oh, I want something sweet. Oh, I'll have some Hershey's chocolate. Like there's
whatever happened to Bud Light post the fiasco.
But Bud Light itself, the sales haven't quite fully recovered. I think they're still down like 15 to 20% from the peak. However, Anheuser-Busch has taken no hit.
Okay.
They've just continued to move up.
Okay. I was just curious because I know there was a lot of disagreements with the whole Bud Light commercials and those type of things, and I was just thinking to myself too, I wonder if these big companies, right now we're starting to catch on to certain rage bait tactics, but companies that were doing it very well beforehand, if they do it well enough, we wouldn't be able to tell that they're doing it.
Yes.
Right. So I wonder if
and I mean, to that end, the Sydney Sweeney has great genes kind of wound up working out as a rage bait tactic. I don't think that was their plan.
Really, I thought it was. I don't think there was any ill intent, but I thought that they knew as they were making it, they're like, oh, it could be taken for this, but like, this is great marketing.
I don't know. I mean, it's certainly possible, but I don't know. I think that they probably just said, "Oh, geez, this is a great play on words," and like kind of whiffed on it. But I don't know. I mean, also they were quick to stand on business when people called them out. So
they were.
Maybe it was part of the calculus that they knew they.
I don't think there was ill intent, but I have a hard time not seeing these intelligent individuals at this level didn't know that was a possible scenario that could play out, especially in their profession. But.
How's Hershey looking? Show me HSY.
How's Hershey's looking? How is Hershey's?
HSY is what it is.
HSY.
Yeah, she.
There we go. It's a little quiet right now.
That's all right.
I will say American Eagle, relative to the move that we saw today, it's been pretty quiet, even with the original launch with Sydney Sweeney. I mean, this move is just... I mean, there's really no other way to put it.
Well, almost always when you see this, like, gap up from earnings like this, you will see downward action the next day. But that's not what happened here. We actually just wound up getting more bull side action, and the bulls are keeping this thing propped up, going towards 19. This is fascinating to me. I mean, whoever American Eagle, you better triple, quadruple your head of marketing salary, because this is insane.
Oh yeah.
I mean, we're talking about a 12 into 19 move.
It's almost 100% move.
Yeah.
American Eagle in less than 3 months. That's nuts. But with all that being said, we got a few things in the portfolio. We got to make some decisions on what we're going to manage tomorrow. Luis, my guy, how we doing? Good to see you. We got some gold. We're short a little bit of gold. Gold's been going on an absolute tear, but we sold an out of the money call spread. Luis, we're short some gold, brother. We'll see how this goes. 43 days till expiration. We need to be a little patient on it. Then we got Google. I know we've got some Google call spreads on. I feel like there's a handful of us. I think there's about half of us that has some short delta on in Google.
Yeah, I'm short.
Are you short Google right now too? Yeah. Sold an out of the money call spread on Google. 43 days left till expiration. NVIDIA, this one's kind of hasn't been doing too much. 43 days left till expiration. Out of the money call spread. QQQ down a little bit on the day to day after that insane rally. 43 days left till expiration. RKT. Get that out my face. We got 15 days left till expiration. One of the risks of the week that we had put it on a few weeks back. I think it was one of the smaller cap stocks we were looking at. And then SPY. We had another rally today. Sold an out of the money call spread. Sold the 640 calls. Bought the 645. I got about 274 on there. So I got maybe $225 worth of risk. 15 days left. Maybe we get a sell off into tomorrow. I don't know. I'm curious about NFP, and I think we're going to end up cutting rates. You have any thoughts on cutting rates? I think it's kind of inevitable at this point, but because we've been raising rates for so long, I think once we start cutting rates, we'll finally be in a different market environment, which could potentially lead to hopefully higher premiums, maybe some higher volatility. It's just been quiet. That's all.
Yeah.
It's been really quiet. I've been waiting for that pop on VIX. That's what I'm waiting for.
Yeah, I agree. I'm also expecting a rate cut is my short answer there.
I feel like that's going to...
I think we might get 50 before the end of the year, like cumulative. I think that's within reason. It feels like this thing is like a bomb. And it does. This pressure is slowly been building up on the rate cut, and it feels like we're about time for it to explode.
It's about to be 2026, but it's felt like I've been waiting for that pullback or that whatever. Guys, what are we waiting for? Ever since 2020.
I'm not waiting for anything. I'm long delta to the freaking moon.
Bro, I can't. Even in 2022, 2023, it's like, really? Are we really going to go higher? Goes higher. Are we really? Goes higher. So, I don't know. This time feels different. And those are the famous last words.
I was going to say, that's like definition of insanity right there. Just the same thing over and over and expecting a different result. Yeah, no. And I will say this Google thing, too. I really, really don't understand this move out of Google. I sort of went on a tangent to you earlier today. This Google thing... 2 months ago, maybe 1 month ago, Google was sliding for a prolonged period because of concerns about AI eating up all of their search engine revenue. And now they get to keep their search engine, and so they go up 10%. It doesn't make any sense to me. I don't get it. Are we worried about Google's search engine revenue or not? I sure as hell am. I will tell you that. I don't know. My Google search usage is, cratered this year. I seldom will search something on Google unless it's really, really quick, low-hanging fruit. But yeah, it's just like I don't get it, and I think that their search engine revenue is only going to continue to fall apart, especially with how just terrible their AI is. I can't believe that Gemini, the built-in Gemini on Google, is not even remotely near ChatGPT now. It's so odd to me. Like earlier today, for instance, in the middle of the day today, Amari Cooper of the Raiders retired, which was gigantic breaking news as he just signed with the Raiders a week ago, and the season for the Raiders starts on Sunday. So he was going to be like their wide receiver 1, wide receiver 2. So he suddenly retires today. I Google to verify, did Amari Cooper retire? First thing that pops up on Google AI summary. No, Amari Cooper did not retire. Immediately below that, as soon as the AI summary ends, is a tweet from Schefter saying, breaking, Amari Cooper has announced his retirement. What? How are you not catching that? How are you providing me the correct results, but the AI can't do it? It doesn't make any sense to me. And even, it really threw me off because the AI said, no, Amari Cooper's not retiring. This was part of an August 2025 hoax. And then right below it is Schefter saying, oh, Amari Cooper's retiring. So Google has got to get on the ball with that. I don't know how that thing is still so.
I don't know how Google didn't I now see Lone talking about OpenAI would have purchased Chrome, but Google is such a massive company. I'm not going to call it a monopoly, but just to give you the sense of how massive of a company it is, I'm surprised they're not a little bit more ahead on the curve.
Well, yeah.
And they're focused on search engines.
I agree, yes. Because they could have clung on to it if there was as good and intuitive as responses right away as there is with ChatGPT, but it's just not there at all.
Yeah.
Yes, I agree. OpenAI probably would have made a move to purchase Chrome. And yeah, like you said, Google is enormous. They have revenue streams coming in from everywhere. People forget that they own, YouTube, they own Waymo, they have a messaging service too, no?
For Google?
Yeah.
Outside of email, like
Facebook has WhatsApp, but I feel like there's
WhatsApp, Google.
I feel like Google has one of those in their bag too.
They probably do. It's one of those things where it's like, oh yeah, forget Google owns this too.
Yeah. But it's just I don't understand this move at all. and I'm worried. I mean, I definitely think that their search engine revenue is going to be cannibalized. I mean, if you look at AI usage market share right now, Gemini is consistently at the bottom of that barrel.
Yeah.
I mean, that's ChatGPT.
I forget about Gemini.
Cloud is like the next.
I did see somebody using Gemini today to help edit one of their photos. I did see that. I was like, oh, in my head, I was like, oh, Gemini, really? That's the preferred AI
I actually
model?
happened to be on Google CEO's Twitter earliher today, and I saw him posting about the new Gemini 2.5 photo thing.
It's like, bro, nobody's listening, bro.
Yeah.
Go ahead, delete that tweet.
Yeah. Go ahead.
Go ahead, delete that tweet, bro.
Pull that down for me, champ.
Delete that
It was
tweet,
actually
that tweet, little bro.
Just a retweet of somebody else's tweet, actually.
Oh, okay.
That guy's name. Sundar. Who's his first name? I can't think of his last name.
Lastly, before we start to wrap here, one thing that's really interesting too with a lot of these tech CEOs is typically a lot of the tech CEOs, you didn't really know the face of them. Typically, the tech guys are usually a lot of the time behind the scenes, and they like to be that way. But nowadays, it's a lot different too. Like with Sam Altman, I was watching a podcast with him the other day, and somebody had made a comment in the comments section that really opened my eyes to these tech CEOs are building personal brands and having their own face and personality to market their companies, right?
Well,
and I feel like Elon Musk kind of led that just a little bit, because I feel even at that realm of individuals, it's like once somebody starts doing it, then the other ones will be like, oh, cool, I'll start doing it too.
Well, I don't know. I mean, I would argue that I think that that's always been around, and it's a founder thing is what it is. Because, I mean, Jobs was like certainly you knew Jobs' face. Bill Gates is the same way.
Yeah.
Like, you knew their face. They were constantly doing these like big, keynote speeches and presentations for their new products and things. Like, you knew what they looked like. But, I mean, I do think that is increasing in prominence. I mean, you see it with Jensen Huang, too, at NVIDIA. He's similarly, public-facing and prominent. But often you lose that when it gets switched out. But I don't know. I feel like Tim Cook is like still recognizable. Like
It's one of the things, like I've never seen Jobs or Tim Cook on a podcast or a relevant podcast that Gen Z's watching, whatever the case might be. So I think the approach of, interacting with the public is a new thing that a lot of these big CEOs are, kind of starting to do and get in touch with.
Remember, pick that penny up. It's true. It's true. Shouldn't pick up pennies in front of a steamroller.
No.
I'll tell you that, though. I'm not even sure exactly what this is about. Did we say something funny?
I know.
Are we funny? Is this us?
I don't know what that was. No, but we got a couple minutes left here. Anything else to add on the way out? We got some volatility coming in tomorrow.
Yeah, I'm trying to think if there's anything else that's on my immediate watch list here. How about Rivian? Let me complain about Rivian for the last 2 minutes.
Go ahead, get on your soapbox.
Rivian, man, can you pull it up for me? Rivian, this thing. Lock in. Rivian is the king of making gains and then just giving them right back. And it's frustrating the hell out of me. I have been long Rivian for so long. I have naked call leaps and I want them. I want to liquidate them. And I've had numerous times where they are very profitable. But Rivian, man, this thing, every time it goes, I mean, it will rip for a day. It'll do 20% in a day and then give it all right back the next day. I've never seen anything like it. It's crazy. This thing cannot hold its gains. Yesterday, Rivian gets a $5.8 billion with a B dollar investment from Volkswagen. They also announced that they're going to start letting people get into the Rivians with their iPhone or Apple Watch. The Apple Key, I think is what it's called. All good news. It rips accordingly. And then today, everyone's just like, never mind.
I'm good.
I'm out. Why? Why, guys? We got to sell it. Keep holding your Rivian, please.
Hey, it's either buy low, sell high, buy high, sell higher. There we go.
Sell higher is right. I saw somebody took a $4 million sweep of Google 250 calls today.
Google 250 calls.
Yeah. So
what does he know that we don't know?
I said the same thing.
Because I might have sold that to him.
Yeah, shout out to Chase for texting me that information. He
definitely sold those calls to him.
He shot me those sweeps earlier today, and it made me feel a little worse about my Google long position. To be fair, Google did have another good day today. So
valid.
This is why I don't get short, Errol. Fuck.
hey man, we gotta throw a little bit of short delta every now and then. Now, anything else to add before we hop out?
No, that's all I got.
Cool. We'll see how this pans out. American Eagle tomorrow. See if they can hold their gains, and then NFP tomorrow. I'm really excited for that. Maybe we get more volatility into the market. I'm not praying on the downfall.
You are.
But I absolutely am. And if we get it, it's going to be nice if we do get the short. I'm not going to lie. The way things are adding up right now. But anyways, that's going to do it for today's segment. Be sure to tune into us again next Tuesday and Thursday at 4:30 Central Time. Be sure to stay tuned for more segments coming on next. We'll catch you guys later. Peace.
And we are back. 90 seconds as advertised. I'm Elias Pilak in San Francisco. That's Jamal Chandler in Chicago. Chris Vecchio from New York will appear on your screen at some point. Stay tuned for that. He'll no doubt take me to task over something. Sir, how goes it?
I'm good, man. I'm good. I mean, it's an exciting time of year. Football's starting up. That's pretty awesome. Kids are back in school. Things are pretty busy. I got a curriculum night at my kid's school tonight. Yeah, you know, I used to feel like that at those things. Now, like, starting when my older two kids that are now in college, starting when they were in middle school, I started saying, I'm going to go to this and just have fun. And I was like the person who was like asking questions and like making the teacher laugh. And you know what I mean? Like, because nobody wants to be at these things. Like, nobody wants to be at it. So if nobody wants to be there, let's just have some fun.
Nobody asks me anything about curriculum, but anytime that there's a parent-teacher conference or something, I'm definitely going in there with zingers, because who's really trying to sit there and just drone on and on and on and on and on? As long as you're there, you might as well have a good time.
That's what I say.
And yes, thankfully, they are back in school. Mine are 4 and 7, and it's been a summer.
Oh yeah, you got the young ones, man. Oh, you got.
I got the young ones.
Yeah, you got.
I got the young ones.
I was talking to a friend of mine the other day. I was like, "Yeah, man, it's I was like, just wait till you get in the thick of it." He's like, "I'm in the thick of it now. They're in kindergarten and 3rd grade." I was like, "Bro, I'm here to tell you that's not middle school, high school. That's when it's really like, yeah."
My sisters are 9 and 11 years younger than I am, so I had a little bit of a window. Oh, but it's going to be action packed. I already know.
Yeah, man. So enjoy it now. Enjoy it while they're young. I know they get annoying, but enjoy it while they're young.
Oh, I mean,
they still listen to you.
They're well. We'll say that. We'll say on air that they do. Their murderous rage knows no bounds. But they are, for all that, excellent. And it's only a matter of time before they outsmart me and spit roast me. And matter of time is like days, not weeks.
Yeah. Yeah. I resigned to that fact a long time ago.
Yeah, see, there you go. There you go. How do you feel about this reset in the markets today? I mean, we've basically gone nowhere all week. We kind of started soggy. We've come back up to where we started, and we're going into this jobs report tomorrow with the markets basically shrugging its shoulders and going, I don't know what in the world's going on. You tell me.
Yeah, it was interesting, right? Like, we started the week down, which, you know, it just seemed as though like one of those situations of everybody's back from a holiday, long weekend, sell a few things. And even with that, I think we bounced towards the end of that day. Like, I know at one point we were down 100. I think we ended the day down like 40 something and change, which was kind of telltale sign, right? And then throughout the week I feel like we've kind of treaded water, but mostly drifting a little bit higher at times. And then today, boy, I didn't have this on the bingo card. I really didn't to end this much higher, but I think it just tells you the market's a little exuberant about the upcoming jobs report. And by exuberant, there's clearly expecting it to be bad. And you know what I'm saying? Like, it's just clearly that's the situation. It's like, okay, go ahead and show us this bad report so we can go ahead and talk about more of these rate cuts that we got coming down the line. You know what I'm saying?
Yeah. I thought it was really interesting today. So we went all the way sideways into the ISM number this morning. Here it was, the ISM number. It was hot. And you can see how much stocks loved it. But then as soon as that number was out of the way, it was like, okay, let's reposition for NFP, because to your point, heaven's willing, it'll be terrible, and then we'll get these rate cuts. And so it's really interesting here, because you get this tiny little sliver of evidence that tells you in the price action, this market wants bad news, which is kind of an interesting place for them to be. They want this rate cut so bad, but it's pretty much in the market now. I mean, if you look at Fed funds futures as of today, we got a 97% chance that we're going to get this rate cut. I mean, that's basically a given now, I would think. And looking at the rest of this year, we're discounting 50 basis points. Looking at Fed funds futures here, 53. So small rounding error. But the market and the Fed has been basically in agreement since May. The Fed's been saying 50 basis points since December last year, before the tariffs, before any of this nonsense. And the markets have been on this boat since May. So what are we going to get in this jobs report that's not baked in already, in your mind?
Jeez, I mean, I think it's hard to say because I think it's expected that it should be a little bit more showing some more softness in the global labor market. I think that's baked in. I think it's hard to say about the unemployment rate. I don't expect it to go up markedly, but I don't know. It's hard to say. That's a good question. I would say. I don't know. Give me some of the inputs. I keep forgetting. I don't know. You guys, know them better than I do. Unemployment rate, the actual number.
We're going to get the unemployment rate. That's expected to go up to 4.3%.
Which is not market, right? Like, that's not huge.
No.
Right?
No, I mean, nominally, right, it'll be the highest in a few years, but that's because it's been ridiculously low relative to history. So if you look at sort of what 4.3 means here, it would be the highest since, let's say, October 2021. But historically, I mean, it's nothing. We historically average something closer to 6 or 7.
Right.
So okay, we're going to go from 4.2 to 4.3. Oh no. Not exactly the scariest thing. The other little bit here that's interesting is going to be average hourly earnings, which is basically a measure of wage inflation. And that's the kind of thing that's sticky. We're looking for 3.7 versus 3.9 last time. That would give us basically a comeback in sort of the direction of favoring rate cuts. That would be the lowest that we've been since July of last year. So helpful. I mean, when we dipped to 3.6 last year, before we then went up back on average hourly earnings, that's sort of stage setting then for the Fed said, okay, we're ready to cut at the Jackson Hole last year. And then, of course, in September, they went big, 50 basis points up front, another 50 basis points before year end. It seems to get lost in the sauce in this whole conversation that the Fed already cut by a full percentage point last year.
Right.
And so